the UN and the former president. They are just so different in so many ways. Trump is the iconoclast, and Haley has been trying to run a much more establishment Republican type campaign, one that's far less of the America first, far less of the isolationist, and one that is trying to hew a little bit more closely to, as I said, the earlier brand of Republican politics.
Shep, is there room in a Trump 2.0 administration for an establishment voice like Nikki Haley?
I think there are some people in the Republican Party who would like to see room for someone like Haley, and for others for that matter, but it is hard to see. The numbers show it in terms of delegates. When you look at Trump, he has 995 delegates to Haley's 89 to the convention coming up. Trump is almost at the point of clinching it. But there's more than that just in the raw numbers. That really signals just how much this has become Trump's Republican Party. And we even see people like Mitch McConnell, I mentioned before, he is stepping back from the Republican leadership in the Senate from that role, in part because he is recognizing that the tide of history is turning away from his brand of politics for now and much more toward Trump's on the Republican side.
Yeah, Karl Rove has been talking about this on Fox News, and he was saying it last night, looking at the margins. Haley's still, even though obviously it's Trump's party, Haley's still picking up 20% in North Carolina, Virginia, almost 35%. How does Trump close that gap come November?
Well, that is the big challenge. And Haley is going to have to make clear to her voters that they have a choice. And Trump will have to do some work to reach out to them to persuade them to vote for him in November. Some of the voters that we talked to when we were out in Iowa and in New Hampshire for some of the earliest nominating contests, the Haley supporters, a few of them indicated to us just randomly that, hey, if it came down to a Trump-Biden rematch, they might cross party lines and vote for Biden. Now, that's unscientific. You know, we would have to do a fresh survey to see how that would break down. But really, the challenge for Trump is reaching out to people who opted for Haley because they didn't like his message and what he was trying to sell to them.
Let's talk about Joe Biden's campaign. He obviously swept last night, but Minnesota, about 20% came out and voted uncommitted, and they were less organized than, say, that group was in Michigan. What does he need to say on Thursday to shore up parts of his base?
Well, Joe Biden has a lot more to do on Thursday night than just shore up parts of the base. It really is a broad message. He is trailing Trump right now in a head-to-head rematch. And in our own Bloomberg News Morning Consult poll, we show the president trailing Trump 43% to 48% among voters if it came down to an election being held today between the two men. Specifically to your question, what do Michigan and Minnesota last night say about Biden's vulnerability? Specifically, that refers to the Mideast. And Biden is going to have to really thread the needle on Gaza. He's under a lot of pressure from progressives in his party who are growing increasingly concerned over his handling of the Israel-Hamas war, and they really want him to do more to ensure that there's an immediate but also a lasting ceasefire for humanitarian reasons. And if he is unable to satisfy that, it risks turning voters away in November simply because they don't have confidence in him on this particular issue. And in a closely contested state like Michigan or even Minnesota, you could see the president really in a tight spot if he loses those voters.
Hey, Shep, wonderful to catch up with you, sir, over in Washington, D.C. If you are just joining us, a dominating evening for the former president, Donald Trump. And Nikki Haley set to head to the exit, 10 a.m. Eastern time. Speaking from her home state of South Carolina, we're expecting that announcement a little bit later this morning. Eric Friedman with us here in New York City. Eric, I want to talk about the Treasury market. It's what Lisa's talking about. It's what we touched on briefly already. We've got two candidates, and I'm not sure if either one wins, they're going to tackle the nation's debt. Are you sure?
No, we don't think it's going to be politically popular for either party. It's probably like out two terms, Jonathan, before this gets addressed. Probably the most important factor we're paying attention to with the upcoming election is number one, trade policy, and then number two, what happens with the regulatory. And so trade policy, look, the sneaky risk in markets right now is that we do see a treasury yield that just hangs around like your in-laws post-Thanksgiving. It just kind of remains elevated. Again, I love my in-laws. I shouldn't say bad things, but...
Good correction there.
Yeah, well done, especially close to Mother's Day. Yeah, exactly. So ultimately, the idea is that, look, this overall level of rates has acted like a ramp on a treadmill. And this economy just can't stand Fed funds at 5.33% in perpetuity. So if we see a trade policy which is more, let's call it, shifts from isolationism to something even more significant, that to us would be inflationary in nature. And so the Fed, Treasury does not want to see that happen, I think, at a bigger scale, because we can't just keep funding, again, deficits at increasing rates.
People have been so hopeful that we're not going to get a Trump-Biden matchup, which is essentially what we're getting, that they haven't focused on policy of each of these different candidates. What do you think could be the most market-moving aspect of the State of the Union from Joe Biden, considering that we haven't really heard what his trade policy is going to look like in a second term, what his fiscal policy is going to look like?
Yeah, I think number one, Lisa, would still be trade policy. And I don't just want to harp on that for redundancy, but do think that, look, President Biden had the opportunity to redact Trump-era tariffs, didn't do that, has had the opportunity to look at some of the micro industries we pay attention to. That just has not been a central thrust. So for us, trade policy would be number one. Number two would be fiscal policy. And I think that you've been right to cover this on this program very consistently. The idea that we have this lagged impact on fiscal. It is a steady drumbeat, if you will. It actually has been a tailwind for us in terms of being more macro positive, but it's not going to last indefinitely. So I think that number one would be trade policy, number two would be fiscal, and also the idea of, look, what measures are they willing to tackle from a fiscal perspective without, again, upsetting this economy, which remains still strong.
Inflation Reduction Act, hard infrastructure, chips, all that fiscal money going out the door. When do you see that actually evaporating, though, in terms of the impact on the economy?
Yeah, tapering probably, Anne-Marie, is like a first quarter of next year phenomenon, meaning that there's this lag. It's almost like monetary policy. It isn't a light switch that turns off and on. It's this dimmer switch, if you will, that has an elongation effect. So, again, by our estimates, we think that it's probably going to be a dissipation sometime in the first half of next year, but probably more pronounced in the first quarter.
Can one, if you want to make that apology against the in-laws, just in case.
It's fine. It's
You
early.
good?
Exactly.
We've sorted that out.
Yeah, he's like, I'll pass.
Eric, thank you, mate. Eric Freeman there of US Bank Asset Management. Lisa, I think you nailed it. We've just been knee-deep into personalities. And I think for a lot of people in this country, and it shows up in the polling, this is not the trade-off, the face-off they wanted again. So we haven't focused on the policy. I think still now, even though we know it's going to be Biden versus Trump again, I don't think Wall Street is ready to focus on the policy just yet.
We've heard from a number of people, we know what you're going to get. Do we? I mean, that's really the key question. Then we hear from other people, well, is it going to be the same kind of thing, or do they double down on certain proposals that they couldn't get through the first term? We don't know the answer to that, but to me, this is what's going to be arguably more market moving than a lot of other things at a time where fiscal support has really been the tailwind driving a lot of this.
Big time. Coming up next on this program, we'll catch up with Bloomberg's Craig Trudell on Tesla's tough start to the year, losing more than a quarter of its market cap in a little more than 2 months. That conversation is coming up shortly. Equity futures on the S&P 500 doing okay, just off session highs. We're positive by 1/3 of 1%. From New York, this is Bloomberg.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Stocks bouncing back on the S&P 500, positive by 0.4%. On the Nasdaq 100, doing all right as well, up by 0.7%. Just in terms of the losses yesterday, biggest one-day move lower since the middle of February on the S&P, end of Jan on the Nasdaq 100. Lisa laughs every time I say it, so I'll give you the why. S&P 500 not suffered a drop of 2% or more in one day since February 2023. Longest run without such a pullback in 6 years. Thank you, Allegra Catelli here at Bloomberg, for that stat. Bramo, we've been starved of big losses.
Which is the reason why I keep asking, what is a dip? It's buyable, but what is a dip? Does this count at a time where everyone seems to be saying that equities are actually the new haven because bonds don't offer you the offset to potential growth and potential ongoing inflation?
Let's focus on some big losses yesterday for the likes of Tesla. That hit discretionary. The likes of Apple, that hit tech. But away from the equity market, the driver in the bond market was really some data we got at 10 a.m. Eastern time just yesterday. It was the services ISM, and the employment component of that contractionary going into payroll. So we've got a bid into the bond market, another one this morning, down a single basis point. Lisa, 454.74. Are we going to get a repeat of the jobs data of last month? Because certainly that data yesterday did not confirm the boom to start 24.
The data's been really noisy, and this is what I felt yesterday, where you hear people basically saying, taking both sides and not really having a clear view. If you took a look just at the ISM services data, not only did you get employment that came in contractionary territory, but also prices paid came in below expectations, so less inflation. Other people are saying, well, there's a seasonality behind January, and February is going to be just as big of a boom. We just heard that from Carl Riccadonna. Put those two things together, soup, you hear voice. I mean, really, it's very difficult.
Can you explain this? Gold, 6-day winning streak on gold, all-time high. Yesterday, again this morning. Gold right now, Lisa, 21.33. What is behind this move?
I am not going to explain that to you. I will just say that some people will speculate that it has to do with Fed policy and the potential to allow the economy to run hot, inflation. Gold has not moved in a predictable manner. Sometimes when people are worried about inflation, we saw this back last year, gold didn't get a bid. Now people are talking about a store of value again at a time where inflation's coming in, and you potentially have Fed cutting rates. Big questions here about whether this can continue.
It's getting a bid now, that's for sure. 6-day winning streak for gold this morning. Longest daily winning streak going back to October 2022. That's the price action. Under surveillance this morning, our top stories, day one of Chair Powell on Capitol Hill, about 2.5 hours away. Powell expected to reiterate a lack of urgency for the Fed to cut rates amid growing concerns about upside risk to inflation. Andrew Honhorst and a team over at Citi expecting a neutral tone, with the Fed chair likely to highlight the need for more data and the importance of not overstating one data point in the wake of the hotter than expected January CPI print, together with that blowout payrolls report. So we end up on payrolls Friday all over again. These comments are going to come before that data drops on Friday. Will Friday's data confirm that 350, whatever it was, 353 for the month of January?
And some people are saying it probably will, that there was actually quite a bit of strength under the hood. We heard that again from Carl and from a host of other people who've come out and said that. What I think is going to be fascinating is that we're all looking at Friday's data. Are we seeing a Fed that is seriously de-emphasized at a time where the data is noisy and people are looking to other inputs to continue this risk rally, not necessarily Fed policy in the way that people were last year and the year before.
Because certainly stocks have done okay in the face of repricing rates a whole lot higher than we thought they would be through most of this year. Just getting this report from Torsten Slock over at Apollo. Torsten, thank you as always. Reasons for a strong February employment report. He offers 4, Bramo. Financial conditions have eased dramatically. Jobless claims remain very low. The fiscal deficit is running high. There you go on that deficit point again. And the employment to population ratio is almost a full percentage point lower than pre-COVID.
And this speaks to his point that the Fed may not cut rates at all, or probably won't cut rates at all this year, but equities could keep rallying because you've got those tailwinds of the fiscal support. You have the idea of a low unemployment, and you have a really strong labor market.
That's the economy. Let's turn to the politics just briefly. Donald Trump, Joe Biden, heading for a November rematch after securing sweeping victories in Super Tuesday primaries. And Nikki Haley, Trump's last rival for the GOP nomination, is ending her campaign. She's expected to speak in her home state of South Carolina at 10 a.m. Eastern Time. Trump and Biden winning almost every Super Tuesday contest, demonstrating their hold over their parties. And it's their hold over those parties that is going to get interesting in the next couple of days, because when we hear from the President of the United States, Joe Biden, tomorrow evening, he's going to be speaking to people within his own party, not just the country. He's got to really get that party united and fast.
So within his own party, we saw again overnight in Minnesota, uncommitted votes, about 20%, which is not anything that you can just shrug off if you're sitting in this campaign. So pockets within his own party he needs to speak to. And then the broader electorate, what Greg Vallier was talking about, with polls and polls continue to show, majority of Americans just think he is too old. So again, for me, it's not so much what Biden says, it's how he says it. How does he come out and communicate this in a robust manner that people feel like, okay, we are giving him another 4 years and we feel confident about those 4 years?
People look at those uncommitted votes and I think they point to the Middle East. I do wonder if it's more than just one single issue driving those uncommitted votes.
Well, when it came to Michigan, you saw a huge rally amongst Arab Americans, Muslim Americans, progressive Gen Z, who are saying that it was about a protest vote over what's happening in Gaza. It could be about other issues, frankly. It could be about, when you look at Gen Z, they feel like he hasn't done enough on student loans. You look at other individuals say inflation is still too high. Prices have not come to where I remember they were under the former president, but these are at the moment just protest votes, but he does have a lot of work to do.
Let's turn to the Mag 7 and talk about some of the movers we've got on the screen at the moment. Tesla, over the last few days, has really struggled, continuing to fall away from the Mag 7, now facing issues in Germany, where a factory has yet to reopen after a nearby electricity tower was set on fire. An organization called Volcano Group claimed the arson, saying, "We sabotaged Tesla." Ben Callow of Baird saying investors should lower expectations for how many vehicles the company will deliver this quarter. This has been a really tough start to the year for this company. Bloomberg's Craig Trudell joins us now for more. Craig, I want to understand from your perspective, first of all, what on earth is going on with production at that factory, and then you can tell me whether this is actually probably not so much of a bad time to lose production, given what's happening with demand worldwide.
Yeah, I think, you know, if you're just following Elon Musk's posts on X, you think, wait a minute, you know, some lefties in Germany have lost the plot and decided to disrupt an electric car factory. You know, what are you thinking? In reality, on the ground, there's real local opposition to this company expanding in what is, you know, a forested area. They cleared a ton of trees to make room for this plant. That was unpopular. It's an area that doesn't have a ton of water, that has a sort of troubling long-term trend for the water supply. Tesla has not, you know, taxed the water supply to the extent that was feared in the early goings, in part because it has decided not to go forward with making batteries on site. But, you know, that's a threat down the line. So, you know, there is real, you know, popular opposition to this company expanding in Germany. That's not to say that it wasn't, you know, an extreme action. Whoever did set the fire to this electricity, you know, infrastructure nearby. But it has shut things down, and it's unclear how long this plant is going to be out of commission for.
When you say that dissatisfaction is popular, is it hardly local, just around that particular factory, that plant, or does it spread right the way through Germany into parts of Europe?
I'm definitely referring to the highly local, you know, opposition, you know, in regards to actually a recent vote as to whether or not the public supported the company expanding. And I do think, of course, you know, it is fair to wonder, to what extent there is some, sort of quiet opposition to Tesla getting any bigger in Germany as a result of the fact that the company has had so much success in Germany and in Europe broadly, with really, making quite a bit of a dent in, the position of local manufacturers. I don't think that we've necessarily seen or heard a ton of that out in the public, and you do, for the most part, hear other car company executives talk about the idea of, look, Tesla is welcome here, and we sort of welcome the fight. I don't think it's necessarily the case that this is, some grand conspiracy of, German car makers sort of, looking out for their own.
Taking a step back, there is a stat that Tyler Cowen, a Bloomberg opinion columnist, put out there that U.S. investments in clean energy and transportation grew 38% from 2022 to 2023, largely fueled by Bidenomics, largely fueled by U.S. subsidies. Are they working? Is it actually creating a dominance of U.S. EV manufacturers, or is it kind of lagging behind as the adoption rate doesn't catch up with some of the push?
Yeah, I think the U.S. is having real challenges, and there's been a lot of conversations early this year about are we sort of getting this transition right? Whether you want to talk about the IRA and some of the execution issues that we're seeing there, I think it's hard to say that has been a disappointment, in the sense that the amount of investment that's going into the U.S. is massive, and it's hard to understate the response that the IRA has gotten. But this is an industry with long lead times that takes years to go from announcing a big splashy battery factory that's going to go up and actually having cells coming off the line, even if you're a company like Tesla, which has struggled to sort of hit the numbers that it was hoping for with its battery factory out in Nevada. So this is something that politicians are going to be tested as to whether or not they have the stomach for the idea that there's going to be growing pains. And on the consumer side, I do think too the fact that we wanted to incentivize EVs, but we wanted to cut China out of the equation. If we really are serious about that, it means we're going to have to deal with some cost disadvantages until we get to a point of scale and EVs really hitting the mainstream.
Craig, I want to talk to you about the IRA and Tesla specifically, because Elon Musk seems to be dipping his toes into politics. We've confirmed, New York Times reporting that on Sunday he was at Mar-a-Lago. This is a time when Trump really needs to bring in more donor money. How much is Elon Musk, how much is Tesla benefiting from these subsidies from the Biden administration?
It's incredible because on one hand, they're a huge beneficiary of the IRA, and on the other hand, Musk will sort of have you believe that the Biden administration is anti-Tesla. And there's of course some merit to the idea that there was very sort of puzzling snubs early on in this administration of the Biden administration wanting to welcome car makers to the White House to make a lot of noise about the EV transition that Biden is trying to make. Of course, he has tried to make that a message of looking out for U.S. workers and particularly union workers. And the fact that Tesla is not unionized and Musk is very anti-union has been a source of great tension between these two. So it's kind of incredible that the IRA has been such a boon to Tesla, and yet if you're sort of following Musk's social media posts, you would think otherwise.
Hey Craig, great to get your thoughts. Craig Trudell there of Bloomberg. Without a doubt, you can go back a couple of years. Elon Musk and Tesla were slighted by this administration to not be included in that. This company almost single-handedly part of the EV revolution in this country, to be left out over union workers. It didn't make sense then, doesn't make sense now at all.
Which raises this question, was it something more personal with respect to the allegiance of where his shift was? That said, the fact that his company is still benefiting from some of the EV transition and some of the U.S. policies really highlights how this is a fraught and sometimes counterintuitive moment for the industry.
This was in 2021, and I was at this event, and I think it really came down to union jobs. President Joe Biden promised to be the most pro-labor union president in American history, so he wasn't going to open the door to Tesla. That said, Elon Musk has said he voted for Biden in 2020, but he said he wasn't sure who he'd vote for. And he has just ramped up his rhetoric ever since that, even most recently saying it's treason what Biden is doing at the southern border. So it's interesting now that he goes to Mar-a-Lago at a time when Trump really could use that campaign donation.
Tesla in the pre-market is doing all right. It's just positive. on the year, though. Dreadful start to 2024. Equities more broadly positive, close to session highs, up by 0.4%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Senator Bob Menendez has been indicted again in connection with an ongoing bribery case. Federal prosecutors added obstruction of justice charges to existing criminal counts against Menendez and his wife. Many Democrats have called on the New Jersey senator to step down after he was initially indicted last September. Meanwhile, independent Arizona Senator Kristen Sinema has announced she won't run for a second term. Her decision ends the possibility of a turbulent race in one of the nation's most politically competitive states. Foot Locker shares lower in the pre-market by nearly 11%. The retailer reported mixed earnings. It saw comparable store sales fall much less than expected, with consumers holding strong despite fears of a pullback on sportswear spending. But the company's full-year guidance failed to meet expectations. The company is anticipating that it will take longer to achieve the goal in its lace-up plan. Wells Fargo is set to unveil a new credit card aimed at competing with the Chase Sapphire Preferred program. Sources tell Bloomberg the firm is planning to add $95 per year travel-focused card to its roster as soon as this week. Wells Fargo will also add transfer partners, including Air France, British Airways, Choice Hotels, to its reward platform for the first time. The new card is part of the CEO Charlie Scharf's mission to make Wells Fargo a bigger player in the consumer space. That's your Bloomberg Brief, John.
Danny, thank you. Up next on the program, markets awaiting day one of Chairman Powell.
He's speaking on behalf of the broader committee, so it's not his opinion that necessarily he could express in the press conference. It is him testifying on behalf of the broader committee.
A preview up next, live from New York. Good morning.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal. That deal. The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Wow.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Session highs on the S&P up here by 0.4%. Yields just about unchanged on a 10-year, 414.87. Under surveillance this morning, markets awaiting day one of Chairman Powell.
He's speaking on behalf of the broader committee, so it's not his opinion that necessarily he could express in the press conference. It is him testifying on behalf of the broader committee. And I think that, we've been in an exceptional period recently where everyone is singing out of the same hymnal at the Fed. Everyone is saying there's no hurry to start moving, but it does seem appropriate to start moving sometime relatively soon.
Here's the latest this morning. Treasury's muted ahead of Jay Powell's testimony on Capitol Hill. The Fed chair expected to reiterate the central bank is in no rush to cut rates as inflation hovers above their 2% target. Cassie Barrow of JP Morgan Asset Management saying this: we still appear to be on track for inflation to fall enough for the Fed to deliver some cuts this year starting in June. The Fed themselves is projecting core PCE to be at 2.4% at year end and to deliver 3 rate cuts. Cassie, I'm pleased to say, joined us right now. Cassie, good to see you.
Good to see you.
Does the strong data to start 2024 change this conversation in any way, shape or form?
I don't think so. So we've gotten strong data, but we want to look at things not just 1 month, but we want to look at them more holistically. And so I think what you're seeing is inflation that has come down a lot. Core PCE and headline PCE both have 2 handles on them as it relates to the year-over-year rates. I mean, that is a lot of progress from just a year ago. And then when I look at the broader economic landscape, things are strong, but what I'm watching for is the risk that they're reaccelerating. And right now, I still see that risk of reacceleration as fairly low. So look at GDP, for example. It was at 4.9% in Q3, then it went down to 3.2% in Q4. Now it's tracking 2% as of the Atlanta Fed's latest GDP tracker. You know, that's the moderation that the Fed is seeing. That's what's giving the confidence to still say, yeah, you know, by middle of this year, we can reduce the amount of policy restriction. 5%, maybe not so necessary when you have a 2 handle on inflation and growth is slowing.
Even if growth does reaccelerate, there are some questions about whether that matters. Chairman Powell himself said, we don't look at strong growth as a problem. Do you look at strong growth as a problem?
No, and I think the difference is, again, this differentiation between growth being strong and growth being reaccelerating or being unsustainable. So that's why I think the labor market data is so important today. And for me, before the jobs report on Friday even comes out, my eyes are actually on the JOLTS report today. So our favorite leading indicator for wages is the quits rate. And you can think about the quits rate as essentially being the bargaining power that the employee has, right? You don't quit your job unless you're confident you can get another one, and you're most likely doing that to get a raise, particularly here in the US when you don't have the same labor union structure that you do outside the US. So we're watching the quits rate. The quits rate right now, even if it stayed where it is indicating that wage pressures should be about the same level that they were pre-COVID. Again, these are the types of things that the Fed is seeing to make them confident that it's still appropriate to cut rates this year.
What would you have to see to be confident that maybe there isn't the same kind of
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
Yields before they start to move lower.
Okay, this is something I'm a broken record with today. Jim Caron came out and said fiscal policy arguably is more important than monetary policy for him. He's going very underweight investment grade credit in particular. We can get into that in just a second, talking about spreads and how it's really closely tied to duration. But he also talks about the fiscal and the overhang. How closely are you watching what proposals there are to see when you have to care about the deficit again?
So, I mean, the deficit matters, and I think it has been an underlying force that's been keeping the economy stronger than we otherwise would have anticipated, and it's been pushing against monetary policy, which has been restrictive. On the other side, you've had fiscal, that's been loose. But I think it's interesting, you know, when it comes to investment grade credit, the corporate fundamentals are just really strong. I mean, we were just going through our scorecards as a team yesterday in our investor meeting, and there are just no places to poke holes, particularly in investment grade, but also in high yield credit right now. So you have fundamentals that are strong. You have spreads that are narrow relative to the recent history. But what we're doing now is we're not looking at the recent history. We're looking at other periods of time where fundamentals and technicals were as strong as they are today. And in those environments, spreads can actually stay very tight and even go tighter than the levels we're at right now.
So this is a really unusual time. You're looking at tight spreads, saying they can go even tighter. We're looking at the equity market that's near all-time highs. And at the same time, we're talking about the Fed cutting interest rates. Can you make sense of that? How unique is this moment?
I think it is unique. I mean, when I think about how unique this cycle has been, I think about the fact that, you know, there are leading indicators that have just been wrong so far this cycle, and we don't know what the ultimate end.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs. Video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
We're grappling with what's coming next, and I see 3 paths forward. You have a soft landing, that's one option. You have a recession, it finally comes, the thing that we were all expecting, all the leading indicators that failed finally work. Or you get the reacceleration, which we've talked about the reasons why we believe the
from the UK, and I'm the inventor of the Gel Razor. And today I'm looking for an angel investor to fund my project, the Gel Razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I did rather all in one. The idea is you pressurise the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision, that's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the Gel Razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Some research that's taking place, lifestyle research, if you will, on the impact
of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. And this is a promising area.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg.
When you have a productivity surge like we are having right now, you can have the economy continue to be fairly strong while inflation continues to moderate.
I don't understand the sticky inflation argument. If there is still a recession at some point, the market hasn't priced it.
All of the ingredients are kind of there for a sustained expansion of the U.S. economy.
It really does boil down to that we are simply not slowing down. Where is the slowdown?
It feels like we're in that kind of sweet spot of benign disinflation and Goldilocks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now. Chairman Powell testimony on Capitol Hill, 2 hours away. It is all about jobs data this hour. 15 minutes from now, the ADP employment report. A little bit later this morning, job openings. On to tomorrow, jobless claims. Then the big one Friday. Bramo Payrolls Friday, just around the corner.
I was wondering how long it was going to take before you mentioned ADP report. It comes 15 minutes before the ADP report comes out. Look, all of the tea leaves are important. The data's been messy. I do think that the JOLTS report, given what we just heard from Kelsey Barrow, is going to be really important to basically either confirm or dispute what we saw yesterday from ISM Services.
Torsten's Lock Apollo said reasons to be constructive on Friday. One of them out of 4 jobless claims. Claims tomorrow. Lisa, we're still looking at claims at 215,000, which is incredibly low given how long rates have had a 5 handle in America.
If you're looking for weakness, you got to look hard. You got to look at the hours worked. You've got to look at some of the quits rates. You've got to look around the edges at some of the commentary. Given that, this data is getting so much messier because you can pick and choose what you want to, but the overlying headline numbers, strong, strong, strong. Unemployment not picking up. 353,000 jobs created in January. Does that get revised lower, or do we just keep on chugging?
Forgive me for what I'm about to say because it sounds so harsh. If you're looking for weakness, look to South Carolina at 10 a.m. Eastern time. Nikki Haley really weak showing on Super Tuesday, and most reports suggesting dropping out later this morning.
Yeah, she'll be dropping out. That's what reports are, even Bloomberg has now reported, following on the Wall Street Journal. You know, Matthew Bartlett said yesterday it's not a presidential campaign, it's a messaging campaign. So the next question is, does she continue the message? And she's got quite critical of the former president in the last few months. Does she continue that messaging campaign, or does she endorse him? And that's what everyone's going to be looking at, because if Donald Trump wants to encompass the whole party, it means bringing her voters along with him. And right now he's not. And that showed last night as well on Super Tuesday.
I'm going to just offer a little hope right now. This is where I basically say we've talked a lot about who is going to be in the race. It's been Trump and Biden the whole time. Now we know definitively it's Trump and Biden. Are we going to hear something substantive and more focus on what their second terms would look like should either of them win? Now that Nikki Haley is out of the picture officially, do we start to shift to really what are they going to be like if they get second terms?
We'll have a realistic conversation then. Let's look to tomorrow evening. All reports suggest that we might hear something from the president about capital gains. I mean, we hear something from capital gains. That's politics. That's not policy. Because as we've seen over the last couple of years, they can't get it done. They can't get it done when everything's blue. Why are they going to be able to get it done in the next term?
Well, he's going to be playing to a lot of different constituents within his own party when the president speaks tomorrow evening. A number of things he's going to want to talk about, especially taxing the rich. When you talk about policies that could remain the same under Trump or Biden, tax cuts, not for everyone, but definitely those under $400,000, maybe $500,000. Democrats, maybe you could see a slight inch up higher in corporate gains, but it completely depends on the shakeup of the House and the Senate. And what Lisa's talking about, and some of the analysts you've seen, it looks like a mixed government. It's going to be a divided government. So then you could expect not a lot to happen.
What both leaders will do is spend, 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 because, Lisa, that's exactly what they have done over the last 8 years.
Okay, so if that's what happens, then when do you get the bond market pushback? I do think, again, fiscal is so important. We hear that from everybody, that's been the driving force. So at what point does that end? And if it doesn't, when does the bill have to get paid?
Taxes and tariffs. You're going to hear a lot about that in the next few months. Equity futures right now on the S&P, session highs up by 0.5% on the S&P 500. Jobs data just around the corner. In the bond market, yields lower by a single basis point, 414 on a US 10-year. In foreign exchange, the euro stronger, dollar weaker, 108.72. Coming up this hour, BlackRock's Kate Moore looking ahead to Chair Powell's testimony. Ira Jersey of Bloomberg Intelligence reacting to ADP data, and PGIM's Tom Porcelli previewing Friday's payrolls report. We begin with our top story. It's Chair Powell day one. The Fed chair heading to Capitol Hill, where he's expected to reiterate the central bank's call to wait and see on rate cuts. BlackRock's Kate Moore saying this: while prices continue to moderate, inflation is still running above target, and we believe the Fed needs to feel a higher degree of confidence before rushing to cut rates. We view rate cuts will likely be appropriate in 24, and we believe that a June 1st cut is realistic. Kate Moore joins us now for more. Kate, great to catch up with you ahead of this testimony from Chairman Powell. We've pushed out the timing of the call. We've reduced the magnitude, and stocks have done okay. A theme for us this morning is just how important, how relevant is monetary policy to this equity market as we speak?
I think people are still fixated, of course, on inflation and on kind of the messaging and tone from monetary policy decision makers. That said, if you kind of look at the internals, John, and what has been performing within the equity market, it has been fundamentals that have been driving stock prices much more than just expectations around inflation. So when we initially got excited about inflation coming down, a disinflationary trend, and rate cuts in 2024, there was a pop in some really kind of lower quality stuff that was getting hit hard on higher rates for longer. But what is performed today and what is performing right now in this market are companies that are putting up good numbers on earnings, that have been raising guidance, and that have very strong fundamentals. So we're going to talk about it till we're blue in the face. Inflation and Fed policy and parsing all of the speeches is going to be what we do for hours on end. That said, we really have to focus on what companies can perform in this economy in order to make money.
Okay, for years you and I were talking about pricing power. When inflation was high, they had this ability to kick up prices and boost margins. Have you been impressed by their ability to preserve margins given the backdrop currently?
Yeah, John, I think you're asking this question because you know I have great faith and confidence in the U.S. corporate sector to continue to maintain margins, even through lots of last year where prices were rising and where there was a lot of strain. We saw companies continuously focus on maintaining margins and think about strategies that would allow them to expand their margins in 2024. I'm actually very optimistic, and I think this is the consensus of a lot of analysts on the street, that margins will gradually expand over the course of this year as prices come down and as companies continue to have this laser focus on maintaining and expanding margins. This is going to be critical for the fundamentals, and as I said, the fundamentals are going to underpin equity risk and sentiment, I think, for the balance of this year.
So your overweight risk assets, strongly overweight risk assets, piling on, shrugging off all the bubble talk. Are bonds a good diversifier? Or right now, are they the toxic ones at a time of concern about deficits and inflation being stickier for a longer period of time?
Yeah, look, we have a significant portion of our portfolio in bonds, but we're not massively overweight when it comes to, say, treasuries. We're seeing a more opportunity in the credit side. I think the fixed income plays an important part in a balanced allocation portfolio. That said, there are lots of parts of fixed income that are more attractive than others. And we've used cash as a tool aggressively over the last 12 to 18 months. We're seeing more alternatives and currency opportunities as well. So I think we need to think holistically about the asset class opportunity set, even though, Lisa, and you know this, I'm very constructive on equities for the balance of the year. We're going to get this periodic pullbacks, but I think that is where you're going to deliver the bulk of your returns for a multi-asset portfolio.
Kate, I've been putting together a project where I'm trying to collect all the worries and put them on a list and then tick them off as people basically shrug them off. Do you have any to put on the list?
Of course. I mean, I barely slept last night thinking about all of my worries. No, Lisa, for sure. There are a couple of things that really concern me. One of the things I'm focused on, and we were paying attention to this with Target reporting yesterday, was what is the true health of the U.S. consumer? Some of the data gets masked by the higher end, or we'll think about the upper 2 quintile of earners. Does low-end consumer continue to show cracks, and what does discretionary demand look like? I worry a little bit about that. I frankly worry a little bit about the election cycle having an impact on overall spending. We've seen in previous election cycles that companies pull back or hold back on non-essential CapEx as they're waiting for, trying to figure out who the next administration is going to be and what that policy will look like. So I worry that could have a dampening effect on overall economy. And then I worry a decent amount around the impact that geopolitical risk and geopolitical tensions could have on multinationals in terms of their overall operations. Does any of this take my enthusiasm out of the S&P and NASDAQ? Not fully, but I think these are things that could be risks for certain sectors as we look through the year.
Okay, it was going through your old calls at the end of last year. Credit where it's due. Top favorite markets, US one, Japan the other. US up by 6.5%, Nikkei 225 up 20% this year. What was it that you liked about Japanese equities? What is it that you still like about Japan?
We've seen a bunch of small green shoots, I would say, across the Japanese equity space. And there was also a large positioning and technical component, John. Japanese equities have been underloved for some time. We continue to see stronger growth across Asia and with some of the trading partners that we thought would bolster earnings across the Japanese corporate sector. And we, like a lot of people, remain hopeful that we will continue to see a change in BOJ policy over the balance of this year, which will change sentiment for the overall asset class. I will say U.S. is our largest overweight by a long stretch, and that's where we're taking our concentrated equity risk. But I think Japan continues to bear some fruit, and we'll continue to have an overweight there through coming quarters.
Some pretty decent fruit, that's for sure. Kate Moore of BlackRock, congrats on the call. Big call. Japan, just massive outperformance year to date so far. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Republican presidential candidate Nikki Haley is set to end her campaign after poor showing in a string of primary contests, setting up a rematch of the 2020 election in November. Haley is due to speak in her home state of South Carolina at 10 a.m. Eastern. Former President Donald Trump swept the Super Tuesday primaries, winning all races except Vermont. Tesla's factory in Germany remains closed after a fire at a nearby electricity tower halted production, adding to the car maker's strains. The company said it doesn't know when production will resume at the factory, which makes about 6,000 cars a week. Tesla stock has fallen almost 11% just in this week alone, driven in part by a plunge in shipments from its Shanghai factory.
House Speaker Mike Johnson will host the parents of imprisoned Wall Street Journal reporter Evan Gershkovich at the State of the Union. Ella Milan and Mikhail Gershkovich will meet with Johnson privately before President Biden's address. He was detained by Russian authorities almost a year ago and has been held on allegations of espionage that he, the Journal, and the U.S. government deny. The U.S. government has designated Gershkovich as wrongfully detained. That's your Bloomberg Brief. John.
Danny, thank you. Up next on this program, ADP payrolls data ahead of the big event on Friday.
What we expect to get from the payrolls is a sequential cooling from the very hot print that we saw last month, but a still robust payroll print.
The ADP jobs report coming up next. You know, the one that people say doesn't really matter and then it depends what happens, and it kind of does for 5 minutes. That's coming up next from New York. This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Live from New York City, equity futures rallying into the ADP report. Futures positive by 0.5% on the S&P, and the Nasdaq 100 up by 0.8. The number we're looking for, 150K. The previous number, 107. In the bond market, the scores going into that print look like this. On a 2-year, yields lower by a single basis point, 452.32. Down a basis point on a 10-year, 413.70. With the jobs data, here's Mike McKee. Hey, Mike.
Hey, John, we come in a little lower than anticipated, but you've got to remember ADP doesn't match up very well with what the government provides us on Friday. 140,000 jobs is what they see were created in the month of February. That is up from 107, which was their initial print last time. The forecast for the Friday jobs payroll report is over 200,000. Now, ADP doesn't contain government jobs, so they're not going to match up exactly, but the track record is they've been way off in recent months. Of course, 107,000 last time, and we got 353,000 for January payrolls. The other news that they put into this is their new pay numbers, and the median change in annual pay for job stayers, 5.1%, for job changers, 7.6%. So not a lot of slowing in that. It'll be interesting to see how this compares with what we get on Friday, guys, because, of course, the Fed would be looking for numbers more like ADP's than what we've been getting from the Bureau of Labor Statistics.
So Mike McKee's being really diplomatic about this, but I think the ultimate takeaway is nothing to see here. The equity market is session highs by 0.5% on the S&P. I'll turn to the bond market briefly. Give it the scores. as you were. We're down about a basis point on a 2-year, 454 on a 10-year, down 2 basis points. Just a small break of 414 here, 413.50. Mike, perhaps more instructive is the data that we got yesterday at 10 a.m. Eastern time. When you look at the ISM services, the employment component of it, and it drops back into contraction territory. Mike, can you tell us how important that read actually is?
Well, it is an important signal. Whether it actually translates into any kind of drop is hard to say because they don't match up exactly, but it does suggest that the hiring process has leveled out and maybe might even be sort of frozen at this point. We got down to 48 for services industry hiring, and of course, we have seen negative numbers for manufacturing hiring. For many months, companies were just hiring anybody who would walk in the door, and now it seems they've probably filled up their payrolls and they're waiting to see what's going to happen with the economy. Interesting number out this morning, the Business Roundtable CEO confidence level reached its highest in 2 years. So maybe we'll start to see hiring pick up again if the CEO's attitudes are any indication of where the economy is going.
Let's talk about whispers, given the fact that we've seen some conflicting data with respect to the labor market. How has that affected the whisper number for the jobs report that we get on Friday at a time where we got, for example, Torsten Slok this morning saying there's reasons to think it's going to be a really positive February number?
Well, it is kind of interesting, Lisa, because in previous months, we've seen the whisper number significantly higher than what the forecast number is. But that's not the case this time. They're only slightly, Wall Street's only slightly above where the forecast of their economists is. So it may be that we're seeing some sort of coming together in terms of this whole idea that maybe hiring has slowed somewhat. Whether we see a significant decline from 353 or whether we get 200 or over, both of those outcomes are not what the Fed wants to see. They'd like to see it even slower. So if you're looking for a hawkish signal one way or another on Friday, it would be the strength of payrolls.
Mike, I love today because we get a whole host of data and we're going to hear all these people telling us why it doesn't really matter, and it just sort of pushes us in the muddle that we're in. Does Fed Chair Jay Powell's testimony matter? We're going to be getting that later this morning at a time where a lot of people say there's nothing to see here. He's basically going to come out and say they're in no rush and repeat what he's already said.
That's pretty much what's expected. There's no percentage in it for Jay Powell to change any kind of testimony, any kind of pattern that the Fed has adopted. And as you mentioned, everybody on the Fed has basically said the same thing. We need more evidence that inflation is going down. So I would expect that's what you get out of the written testimony. Now, what do we see in the Q&A? Maybe depends on how things are phrased. Every once in a while, something drops. So that's always a possibility. You got to pay attention to everything he says. But I wouldn't think he's coming into this to make news.
Interesting. Mike, thank you. Mike McKee, stay close. Mike McKee's going to stand by because the last few times we've had Powell's testimony on Capitol Hill, the pre-prepared remarks have been released around 8:30 Eastern time. So I think that's something we're all going to look out for in about 10 minutes to see if we get a repeat of that. So we'll catch up with Mike again in just a moment. Let's go through that data again together. So the ADP report, I think we're going to move on from this pretty quickly. 140 was the number, 150 was the estimate. The previous number was a revised 111. And since there's nothing to see here, this equity market rally continues by 0.5% on the S&P 500. On the NASDAQ, higher by 0.9. This is a bounce back from yesterday's losses and maybe a bit of an appetizer for the jobs data you'll get later. Job openings coming later this morning, jobless claims coming tomorrow, then onto payrolls on Friday. Lisa, even with that negative print in the ISM report, the employment component of it for services, payrolls, the estimate in our survey, can change, of course, is still 200K.
And we're hearing that. We heard that from Cara Gadano. We heard that from Torsten Slok, that the expectation is for a stronger labor market report than some people are even expecting. Is services specific to really just this issue of trying to gauge whether things can go further rather than a real test to the overall economy?
Let's get some commentary from Ira Jersey of Bloomberg Intelligence, some reaction to these jobs numbers and a preview to Chairman Powell later on this morning. Ira, your thoughts on what we got from ADP and ultimately what we heard yesterday and what you're looking for on Friday?
Yeah, so I agree with what you had said before, John. You know, this is a come and go kind of number, especially since it's usually overshadowed by the payrolls report. Importantly, what I'm looking for on Friday is you know, even if we get a 300 print or 150 print on payrolls, yeah, that'll catch some attention. But it's really the job data, the wage data, as well as the hours worked, because you know what's keeping and propping up the economy right now is consumer spending, and consumers, as long as they can continue to get raises and continue to have disposable income increases, they'll continue to spend some of, at least a large portion of those wage gains, and that can keep the economy going for much longer. And I think that's something that will need to be addressed today by Chair Powell. So 8:30, as you mentioned, the last couple of years, we've gotten a preview of those prepared remarks, but it is the Q&A, like Mike McKee just mentioned. The Q&A is what matters, and when you look at the bond market and where all the volatility stems from, it's usually some off-the-cuff comment that occurs sometime between 10:30 and 12 when Powell's asked some crazy question and kind of has to answer off the cuff.
Is it 30 minutes, Ira, that's how long it takes for him to get annoyed with them and just start saying things?
Well, you get the committee chair, the committee vice chair, the one of the subcommittee chairs. They all make their opening remarks. Then Powell does his opening commentary, which you know we'll already have had for a couple of hours by then. And then finally around 10:30 is when the first round of Q&A will start.
Which is when he will be sufficiently tired and irritated to basically just say what he thinks. I am curious what it would take to break out of this range of, say, 410 to 430 on the 10-year yield based on testimony that people aren't expecting a lot from.
Yeah, I suspect it won't be toward lower yields, because I think that Chair Powell is going to probably be a little bit more cautious about when they're going to start cutting interest rates, and that will prop up Treasury yields a little bit, so prices down, yields a little bit higher. But it would take him being much more dovish, right? So in order to get down below 4% on 10-year Treasury yields, I think he would have to suggest that they see a more pronounced slowing in the economy than most of us see in the hard data that's coming out, right? You guys have talked about yesterday's ISM employment report. One of the interesting things that's been going on that we've highlighted over the last few weeks is you have the hard data, so things like payrolls and retail sales and that look pretty good, whereas the survey data, so the way people feel, has started to roll over a little bit. You have some chinks in the survey data, but people don't necessarily do what they say, right? And people are still spending money. People still have jobs. People are still hiring, even if it's not at the same pace that they were a year ago. So the economy is being propped up. So I suspect for the long end of the Treasury market, we're going to kind of hang out here. Whereas things like the 2-year yield, that's going to go up and down just based on, hey, is the Fed going to cut all the way to 3.5%? Or are they only going to cut to 4%? That's where you'll see the front end can be much more volatile than long end Treasuries at this point.
Ira, typically we frame this as a grilling on Capitol Hill, and every single time we get it wrong. How political is this going to be ahead of the State of the Union tomorrow evening?
I think it's going to be pretty political. I mean, you'll have things like just this morning, you had a letter from 2 Republican senators. He's in front of the Senate tomorrow. He's in front of the House today. The House members tend to be very political. They all get a very short amount of time. In fact, it usually takes like 3 minutes for someone to ask a question because they're trying to grandstand. And then, Powell has 15 seconds to say yes or no, effectively to some question. The Senate tends to be a little bit more highbrow. So actually tomorrow, you might actually provide more interesting information and detail and nuance than today's testimony will, just because of who's asking the question and how much time the members get to actually ask those questions.
They've got campaign videos to make, Ira, you know that. Ira Jersey of Bloomberg Intelligence. Ira, thank you. Andrew's Holland Horse, City, just writing this one. Mr. Powell goes to Washington. This is what he's going to do, apparently. He is likely to push back against some calls to lower rates by emphasizing that the Fed plans to cut rates later this year, but will proceed patiently and carefully to guard against re-accelerating inflation risks.
What I find interesting, is it going to be Democrats and Republicans on the fringes both being on the same level, saying cut them aggressively? Really, I mean, it's at a certain point, start to converge.
I imagine there's some Republicans that would quite like another few hikes going into the election.
Sure, yes, right. Maybe like...
I'm not sure those calls for cuts will quite be as loud as the other side of the aisle. Coming up next, PGIM's Tom Porcelli looking ahead to Friday's payrolls report and a preview of Chairman Powell. That's next. This is Bloomberg.
timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
The ADP report already very, very stale. Came in at 140. The estimate was 150K. Equities near session highs. Going into Chairman Powell's testimony, we're positive by 0.5% on the S&P. On the Nasdaq, up by 0.8%. Into the bond market, 2-year, 10-year, 30-year. Yields lower yesterday on that ISM services read. The employment component negative. We're lower again today. We're down 2 basis points on a 2-year to 453.90. With those prepared remarks from Chairman Powell, they drop again at 8:30 Eastern. Mike McKee standing by to break it down for us. Hey, Mike.
Hey, John, you were right about what time they are releasing the testimony. They end the suspense early, but there's almost no reason to. Nothing for Wall Street to trade on here. This is all old news. Basically, Jay Powell saying what they have been saying for some time in their statements in the press conference. We believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year, but the economic outlook is uncertain, and ongoing progress toward our 2% inflation objective is not assured. He does give a little bit of a brief outline of where the economy is. Strong job creation, inflation has come down, but there's farther to go before they can consider the idea of rate cuts. And he says cutting too soon, and they've said this before as well, risks inflation getting out of control again. Cutting too late risks recession, so they're going to do their best to stay on top of the economy and make sure that they time this correctly. But no hints about timing, nothing about the balance sheet. The Fed is basically on autopilot here for the testimony of the chairman, which is only about 2.5 pages long. So it is going to be, as we said earlier, the Q&A that will provide any news that we might get.
And no big moves in this market either, just to go through them for you. Starting with stocks, equity still positive by 0.5%, up by 0.8% on the Nasdaq 100. A bounce back from the losses of yesterday. Yields were a little bit lower. They stayed there. We're down a basis point on a 2-year. 454 on a 10-year, down 2 basis points to 413. Mike, this line, this word, confidence, it's a word that he used, a phrase he used back at the end of January. We've had a bit of data since then. Do you think he's gained confidence or lost confidence based on the economic data of the past month or so?
I think he may be questioning where we might be going. And I think Raphael Bostic from the Atlanta Fed earlier this week is kind of saying the quiet part out loud, that there are signs maybe we're going to see a little more strength in the economy going forward, and that could push inflation up. Obviously, the CPI, the PCE coming in hotter than expected. They are concerned about that if it develops into a trend, but it's only been 1 month, so they're not really going to question their assumptions at this point, but they're going to be on heightened alert.
Mike, everyone's going to be watching and paying attention to this, but it does feel like the Federal Reserve and Fed Chair Powell has been de-emphasized in a market that's looking beyond to the data, to other types of factors and other types of spending. Would you agree with that?
Well, I think at this point there's an awful lot going on up here on Capitol Hill, where they're dealing with the budget, they're dealing with the election year. So yes, the Fed has been de-emphasized some. It may be more important from a political standpoint because Republicans obviously don't want the Fed to be aggressively cutting rates into the election because that would be good for Joe Biden, and Democrats don't want the Fed on hold too long because that would not be good for Joe Biden. So in that sense, it matters, but the state of the economy is pretty good, and this is going to be one of those cases where no matter what party you're in, you're going to criticize the other party, but go home and talk about things are pretty good in my district.
Mike McKee, thank you, sir. It's always the way. Playing politics with the economic data. Mike McKee, one of the best down in Washington, D.C., breaking it all down for you. So about 18 minutes ago, we had the data, the ADP report. That came in at 140,000. The estimate was 150. The previous number, a revised 111. Not too bad. Pretty decent in the grand scheme of things. What does it mean for Friday? Not much at all. But ultimately on Friday, the estimate is pretty lofty. 200K is the median estimate in our survey. Then we've heard from Chairman Powell in the prepared remarks. A couple of quotes for you. Here's one. We believe that our policy rate is likely at the peak for this tightening cycle. If the economy evolves broadly as expected, it would likely be appropriate to begin dialing back policy restraint at some point this year. But the economic outlook is uncertain, and ongoing progress towards our 2% inflation objective is not assured. This was always about gaining confidence, Lisa. He talked about that at the end of January. We've had some data that I would say to some extent, and we can debate to what degree, but to some extent, that data would have knocked their confidence just a little bit.
Which is the reason why maybe someone could read into the idea that they're talking about peak policy rate is taking the idea of another rate hike off the table, which somehow anew entered the conversation after some of this hotter than expected data. Otherwise, this is the calibration that they've been making. It's not telling us a lot of new information.
Tom Porcelli joining us now out of PGIM on the latest. Tom, you've had some time to digest those comments from Chairman Powell, think about that economic data from earlier this morning. What's the big takeaway for you?
Yeah, I think you set it up perfectly. It's like, is there really a big takeaway? You know, it's ADP sort of is that tree that falls in the forest and no one hears. I think that there's some interesting stuff in there that we can talk about. And I think Powell, you know, sort of hit one right down the middle, which is exactly what he was supposed to do. I mean, there was no reason to break new ground relative to what he said at the last presser. So I'd love to make this really sort of engaging and, you know, sort of rip-roaring conversation about Powell and ADP, but we'd have to stretch.
Well, but Tom, so let's not, right? But this to me is interesting in and of itself, right? We don't have to. It's interesting in and of itself. I mean, I'm old enough to remember when the Fed was everything, and that's all the people tracked, and that Fed policy drove the markets, Fed policy drove all economic thought. Have we moved beyond that, where suddenly Fed policy doesn't matter that much? It didn't matter in terms of restrictiveness, in terms of tightening this economy, and it's not going to matter if they cut by 25 or 50 basis points.
Yeah, so I think this is a really important idea, Lisa, and it's something that we've been sort of kicking around. You know, it's if I think about like the home builders, right? If I think about like new home sales are sort of hanging in there, aren't they? Existing home sales are getting absolutely clobbered, but new home sales are hanging in there for I think one really important reason. The builders are doing these pay downs, right? They're doing these mortgage pay downs, and if you speak to our home building team, what they would tell you is that it seems that there's some like magical number around 6%. If you offer sub 6% mortgage for a potential buyer, they sort of leap at that. Now, that's interesting to me as an economist because I think, well, okay, mortgage rates on average are around 7% right now. You know, if the home builders are an example, then if the Fed cuts rates, you know, 75 to 100 basis points, which is what we expect, we're looking for 75 basis points, then all of a sudden you're at this sort of magical number. Why is that important? Not so much from hey, let's reignite sales, but let's maybe get some home equity extraction. I mean, I think this, you know, think about the amount of home equity that's sort of, you know, in just sort of sitting out there idle, locked, because rates are so high. I think that's where sort of the rubber meets the road on this. I think it's an interesting idea that not a lot of people are talking about.
So, Tom, given that, do you think that the risk of reacceleration in the economy is that much greater? With a Fed still poised to cut at some point this year, and with an economy that's being fueled by fiscal stimulus and by consumer balance sheets that are pretty good.
Yeah, balance sheets are pretty good, Lisa. And, you know, like I would say, look, we've been in the soft landing camp. I've been at PGIM for 8 months. We've been in the soft landing camp for 8 months and maybe even a little bit longer than that. And what I would say is, you know, when we were thinking about soft landing, you know, we were thinking of it in a range of, call it 1 to 1.5%. But you know, you're easily in the upper end of that range now, and maybe even bleed a little bit north of there. So not making any wholesale changes, just sort of acknowledging that, sort of things have come in a little bit better. We do recognize, though, so one of the things I've been saying is, look, so sure, 24 I think is going to be a good year from a growth perspective, full stop. I do think it's worth remembering how it's basically being driven. And it's being driven by credit usage, and it's being driven now by a drawdown in the muscle of saving, right? Forget about excess saving, right? We all appreciate that's long since gone. But if you look at sort of, the pool of saving that exists now, and if you look at that relative to, where you would have been had the pandemic not happened, you're getting below that now, right? So you're cutting into saving muscle. And I say all of that to highlight, like, how sustainable is that really? Can you continue to sustain that over the coming couple of years? And the short answer is you sort of can. You can continue to drift into that saving muscle. You can continue to use credit as much as those spigots remain open. So I think for the next couple of years, I think it's really easy to sort of make that case. And I think the Fed is acutely aware of that, which is why I think when we think about cuts, the cuts to come, again, we've been in the 3-cut camp for a while. I don't think of that as anything other than this is sort of the Fed just sort of right-sizing policy, given the fact that inflation has slowed.
Right-sizing policy to where it may end, which might be, say, 4.75%, which or something of that nature. I mean, but this is really where I was going to go. When you talk about credit, you're referring to consumer credit, but really it's the credit of the full faith U.S. government that's really been driving a lot of this. When does that come home to roost? When is that a problem when it comes to the bond market, when it comes to understanding investor pushback?
Yeah, I think the reality is, this is one of the benefits of being the world's reserve currency. You get a pass. We haven't really seen, any notable backing away at large from treasuries. We were just at a monetary policy conference last week, and this was one of the big takeaways. So I'm not saying that that's necessarily the right approach to managing your fiscal position, but I'm saying that's what is. This is what's happening. So look, when I think about fiscal policy going forward, I think it's going to be very difficult for fiscal policy to really provide any meaningful sort of thrust. Short of providing consumers with some direct stimulus, which, as I think we all appreciate, is simply not happening. So I don't know that you get a lot of additional fiscal thrust over the coming year or even two, but it's out there, and its deficits are going to remain incredibly loaded for the foreseeable future.
Well, to Lisa's point and almost obsession with this, what would happen first? Would fiscal policy be changed because of an issue and a mistake that potentially could happen in the bond market?
So here's an interesting thing that I think everyone should sort of keep in mind. Recessions make fast friends of politicians. I mean, that's sort of almost always the case. And again, we don't have one built in right now. We have relatively elevated probability of one, but if steady state is 15%, we have 20%. And that sort of modestly elevated proposition is mostly because we're acknowledging that maybe there's a risk that the Fed does not cut at all. But if that left tail risk does come to fruition, I think you have to acknowledge that no politician, whether it's a Democrat or a Republican, likes to endure a recession. And I think that's the thing that could really sort of feed the fiscal beast a bit more. So that's the tail risk, though, I would stress, and that's not where we see things sort of shaking out.
True. Hey, Tom, before you go, I just want to get your thoughts on payrolls on Friday. What are you and the team looking for? What should we be focused on?
Yeah, Jonathan, I think it could actually be a really sound number. I mean, we think it could easily be 250,000, which I think was probably above consensus last I looked. I don't know that I'm a big believer in that, though, Jonathan. I would stress I think that there is some seasonal quirkiness going on here. I think once you get to the March number, I think that's probably when you start to sort of scale back. The other thing I would highlight is I know everyone made a big deal about average hourly earnings. I hate average hourly earnings, honestly. It's like it's just such an incomplete measure of wage dynamics.
Why, Tom? Why?
I always look at average because average weekly earnings is a better way of thinking about this. Average weekly earnings takes into account not just average hourly earnings, but how many hours you work. So if you actually had a setup where hours fell by more than average hourly earnings rose, then average weekly earnings was down. And that's exactly what happened last month. So to me, that's the right way of thinking about wages, and that's what we'll be focused on.
Interesting, Tom. Love that. It's good to catch up, sir. It's good to see you. It's been too long. Tom Porcelli there of PGIM breaking down the jobs data. 140 a little bit early this morning, 140K in the ADP report. The estimate was 150. Looking ahead to payrolls later on this week on Friday, 200K there is the median in our survey. So that's the consensus call, if you will. We're looking for 250 over at PGIM. If you're just catching up with us, we got some prepared remarks from Chairman Powell as well. These are the comments we've had from the chairman going into this testimony on Capitol Hill. Day one in front of the House Financial Services Committee, a little bit later this morning, 10 a.m. Day two tomorrow in front of the Senate Banking Committee. Here are the quotes for you. We believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economic outlook is uncertain, and ongoing progress towards our 2% inflation objective is not assured. Lisa, again, this word confidence coming from the chairman, a lack thereof.
And what's going to give them that confidence? Remember all those times we were asking, is anyone going to ask them that? Are they going to give any insight into that? And the answer is no. And basically, we're probably not going to today, and probably no one will even ask them about that. But that really is the key question. What will be the threshold to get them over and have that confidence?
I hope that question is asked. Otherwise, what's the point? Equity futures going into the opening bow, 46 minutes away. Futures are positive and near session highs up by 0.5%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The U.S. government is pressing allies to further tighten restrictions on China's access to chip technology. Washington wants the Netherlands, Germany, South Korea, and Japan to limit Chinese access to exports and repairs of specialized chemicals and equipment critical for making semiconductors. Sources say Tokyo and The Hague have reacted coolly to the latest push, arguing they want to assess the impact of current curbs. Senator Bob Menendez has been indicted again in connection with an ongoing bribery. Federal prosecutors added obstruction of justice charges to existing criminal counts against Mendez and his wife. Many Democrats have called on the New Jersey senator to step down after he was initially indicted last September. Meanwhile, independent Arizona Senator Kristen Sinema has announced she won't run for a second term. Her decision ends the possibility of a turbulent race in one of the nation's most politically competitive states. Wells Fargo is set to unveil a new credit card aimed at competing with the Chase Sapphire Preferred program. Sources tell us the firm is planning to add $95 per year travel-focused card to its roster as soon as this week. Wells Fargo will also add transfer partners, including Air France, British Airways, and Choice Hotels to its reward platform for the first time. The new card is part of the CEO Charlie Scharf's mission to make Wells Fargo a bigger player in the consumer space. That's your Bloomberg Brief. John.
Danny, thank you. At this point, why doesn't a bank just buy an airline? Or why doesn't an airline just buy a regional bank?
100%.
You know, why don't they just get it
Think
done?
about this all the time.
Same industry.
What is this
get it
dance?
over with.
Exactly. I mean, were we flying something, or are you basically flying a credit card?
Stop pretending you're in the flying business.
Exactly.
Buy Spirit. Or not.
Well, I don't know. Well, let's see.
Will they let that happen?
Maybe they'll
I don't
ask
know.
about that on
Big
Capitol
ideas
Hill.
coming up on this show. Up next, Chair Powell, day one.
We've gotten strong data, but we want to look at things not just 1 month, but we want to look at them more holistically. What I'm watching for is the risk that they're reaccelerating. And right now, I still see that risk of reacceleration as fairly low.
A preview coming up next. Chairman Powell, about 1 hour, 15 minutes away on Capitol Hill.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right? Well, yeah, you know, you got to be smart about this.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Celebrating the good old days, just around the table. The days when Steve Raschuta had to go down to Washington, D.C. to watch the testimony himself because there was no internet.
Yeah.
They weren't streaming it.
Go to the public records.
I was saying I heard some great stories about that. I remember covering the ECB and the old Bundesbank reporters talking about how they used to go to the decision and then run to the payphone. Gen Z's watching thinking, like, what are they talking about?
What is a payphone?
What? Payphones? Under surveillance this morning, Chair Powell, day one.
We've gotten strong data, but we want to look at things not just 1 month, but we want to look at them more holistically. And so I think what you're seeing is you're seeing inflation that has come down a lot. Core PCE and headline PCE both have 2 handles on them as it relates to the year-over-year rates. I mean, that is a lot of progress from just a year ago. What I'm watching for is the risk that they're re-accelerating. And right now, I still see that risk of re-acceleration as fairly low.
Here's the latest. Powell set to speak in just over an hour in front of the House Financial Services Committee. The Fed chair saying in prepared remarks, quote, "We believe that our policy rate is likely at its peak for the tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economic outlook is uncertain and ongoing progress towards our 2% inflation objective is not assured." Steve Raschuta of Mizuho with us around the table for more. Steve, we won't talk about the good old days. We'll talk about the next couple of hours down on Capitol Hill. What are you expecting from the Fed chair?
He's got to walk a fine line. He knows he has to walk a fine line. He's capable of doing it. The problem really becomes when he gets off into the weeds. You know, when he's answering a question and he starts to deviate from script, then the Jerome Powell comes out that the market loves. And that's a Jerome Powell that wants to maximize social welfare. It's a Jerome Powell that really likes the idea of keeping the labor market tight as long as the markets allow them to do it. And let's be honest, where 10-year notes are right now is telling you the market's inflation expectations are still anchored. So there's more likely that if he's going to skew towards 2 rather than 4, rather than 3, or 4 rather than 3, I think there's more likely Jerome Powell's inside nature leads him towards 4.
You've touched on something really quite revealing. Are you saying that Chairman Powell instinctively just wants to make people happy? Because that's what we've heard on this program before.
I don't think he wants to make people happy. I think he looks at his job and his dual mandate, and the dual mandate essentially requires the Fed to maximize social welfare. If you think about it, we want full employment and low inflation. That's maximizing social welfare. And he really takes that seriously. And to a great extent, let's look at where we are. We've got an economy where the labor market is tight, been tight for a very long period of time. We've got a market where inflation expectations are low, and they remain low, and yields as a result at the long end of the curve remain low. So why wouldn't you be happy? To me, to a certain extent, this is a bit of a victory lap for them. They're getting what they want. Why upset the apple cart?
I feel like this is kind of kabuki theater. Everyone's talking about the Fed's testimony, but no one actually cares. Why does no one care about this particular testimony?
Well, I think the whole nature about this particular testimony is the fact that we know at the end of the day there's going to be a meeting very soon. And at that meeting, we're going to have a new summary of economic projections. We're going to have new dots. So a lot of what comes out of this is believed to be sort of old information. We don't expect them to cut new ground in here, where a few weeks from now, we're going to be cutting new ground. In fact, the Fed is going to distribute to all the primary dealers later this week, if not today, the questions that they want us to answer before they go into their deliberations. So everyone knows and is waiting for that, and everyone's waiting for payroll employment. So this is kind of like responding to old news. It's a little bit like the JOLTS data. You know, it's January JOLTS. We know the labor market was tight in January, so the probabilities are the JOLTS data for January will be healthy numbers.
So, and forgive me, but then what will jolt this market, right? If we're looking right now at data points that are backwards looking and that are confusing, you've got Fed officials who are basically not telling us anything. What will give us some sort of lodestar to kind of guide to some new economic narrative that sticks for longer than 3 minutes?
I don't think you're going to get that until you get closer and closer to now. But the market didn't care. The market just kept long-term real rates high. And that was one of the reasons why he lost the election. And the reality is when Bill Clinton came along and changed the fiscal narrative, suddenly we all cared and long-term rates dropped and we had the Bill Clinton economy that followed on the backdrop of it. Today I'm sitting here, real rates are very, very low. Overall nominal rates are very, very low. We have a fiscal budget that's out of control. I think once we get into the narrative of what's really going to happen with fiscal policy with the next administration, and we begin to realize that both of these people are going to spend money and they start talking about tax cuts on top of a $1.6 trillion deficit, that's when I think the real long end of the curve, the real yield to the long end of the curve, could turn around and say, wait a second, guys, there's a problem here.
If we have to wait for the election to understand the fiscal picture, should Jay Powell also wait till the election to know when or not to cut rates?
That's a hard question. I don't think the economy is going to give them an opportunity to cut rates. Let me just put it to you that way. I think they want to cut rates. They really are uncomfortable with rates being above 5%. But I don't think they're in a rush to do it. And I don't think the economy is going to give them the excuse to do it. So I think you wind up in an environment where we will probably spend all year pushing out the rate cuts. All year pushing out the rate cuts. But they're always going to promise them to you.
And you think we'll end up with what? You think we'll end up with none?
For this year, that's our call. We have none priced in. I have none priced in because I don't know when they can start. And if I don't know when they can start, how can I figure out how many they're going to put in? Because the data is just not there.
Interesting. Team Torsten Slock of Apollo joins with Steve Raschuta of Mizuho.
Yeah, well, I'm just sitting here wondering, when the Treasury market cares, what will it take to sort of care in terms of level? In other words, what level do you see it jumping to?
Well, I mean, if you look at where real yields should be in an environment of a $1.9 trillion structural deficit, as opposed to a $1.6 trillion, let's just round it up to $2 trillion structural deficit, you're looking at real yields that should at least be 100 basis points higher than they are today. So, I mean, eventually I think there will be that step up. Right now, the biggest risk that the market faces is the market gets the sense eventually that 2% isn't really the real target. Maybe they're willing to accept 2.5.
Yeah.
And if they wind up accepting 2.5, or that's where we bottom out, then again, the curve may actually steepen from the long end rather than from the front end, as everyone has been anticipating. And that, I think, is the other short-term risk to worry about.
Steve, I could kick around this conversation with you all day. This was great. It's great to see you. Steve Raschuta of Mizuho looking for no rate cuts in 2024. Here's your tomorrow. The lineup looks like this. Ed Yardeni of Yardeni Research, Christina Campmany of Invesco, the brilliant, legendary Howard Marks of Oaktree, and Bank of America's Michael Gapin. That's tomorrow. Chairman Powell coming later this morning from New York City. This was Bloomberg Surveillance.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
From New York City for our viewers worldwide, a very good morning. I'm Menace Cranny in for Jonathan Ferrell. We saved the day. It was a pause, not a panic yesterday. We lift this morning, technologies on the up. CrowdStrike saves the day along with NVIDIA, and Powell just leaves the door open for rate cuts. Countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferrell.
Very good morning. Coming up, Jay Powell staying on message with the chairman heading for Capitol Hill. A muted move in markets as the Fed chief signals rate cuts are on the way. And Nikki Haley drops out, setting up another Biden versus Trump presidential election. We begin with the big issue. Chair Powell singing the same old song.
Powell, sort of picked one right down the middle, which is exactly what he was supposed to do. I mean, there was no reason to break new ground relative to what he said at the last presser. So I'd love to make this really sort of engaging and, sort of rip-roaring conversation about Powell and ADP, but we'd have to stretch.
No reason to break new ground. Mike McKee is with me. Powell reiterating, of course, Mike, good to see you, that they're going to need to see more confidence. And that's the critical word here. They just don't have the confidence to cut just yet. Mike, good morning.
Good morning, Manish. I was expecting you to break into song at the top of the show there. We all know the words. Jay Powell repeating them again today. His press conferences, the Fed statements, it's all the same thing. We believe that our policy rate is likely at its peak for the tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But he doesn't say when that point is, and he warns that the economic outlook is uncertain and ongoing progress towards our 2% inflation objective is not assured. So the bad news for everybody on the trading desk, you're going to have to watch the whole hearing because something may come up in Q&A about timing. There will also likely be questions about the budget deficit. Whose fault is it? How could they fix it? He'll dodge those questions. New banking regulations and capital requirements for banks. That's a bet noir of the Republicans, and they'll probably beat him up a little bit over that. They haven't released those proposals yet, but what we do know about it is that it represents an increase in expenses for banks that they don't like. And then what's the story with the balance sheet? Doesn't talk about it in the statement. The Fed is losing money on its balance sheet right now, not officially, but essentially in an accounting sense. So that may be a concern of some of the members here. They'll probably many of us all like the idea that the economy is in pretty good shape, even if they're not getting an answer that rate cuts are coming right away. Certainly the markets did not change their views. You can see May, June, July there, almost no change in Fed funds futures for the speech in the speech aftermath. So at this point, we're all still on hold, and everybody's got to watch the hearing to see if anything changes.
Okay, no reason to break new ground here. Mike McKee, thank you very much. Let's see if the narrative shifts. Let's begin and continue that conversation. Bob Elliott of Unlimited, Jim Bianco of Bianco Research. Gentlemen, good to have you with me this morning. I've got Mizuho in the last 5 minutes coming in. No reason to see a cut on the table this year. Torsten Schlock talks about last week at Apollo. No reason. The risk is no cut this year. Listening to the narrative and how tight this is. Jim, can I get to you first of all? You talk about a no landing scenario. Can I put you down for no cut this year?
Yeah, you can throw me into that group as well, too. I was at 0 to 2 cuts at the beginning of the year, and I'm more closer to 0. And the no landing camp, what it means is what I think Jay Powell's trying to say. He wants to cut rates. He just doesn't have the data to do it. It's too strong. The inflation data, I believe, is showing signs of bottoming, and it's bottoming at way too high a level, near 3%, not near 2%. And the economic data is too strong for him to be cutting rates. So he'll wait, and he'll wait, and he'll wait. And then I think the calendar's going to run out, and we're going to wind up with no rate cut this year.
Okay, so you're joining that band, and of course you talk about a reevaluation of inflation and the interest rate expectations. So good morning, good to have you with us. Let's talk about the no landing, no rate cut scenario. Bob, I take it you're a little bit less keen on joining the no rate cut camp today.
Well, I think the main thing to focus on is the ordering, because the ordering of market conditions is going to determine the Fed's policy. And the way that I describe it is until bond yields rise, the Fed is not going to cut. And the reason why that is that under the current interest rate structure, this economy does have an incredible amount of momentum. Asset prices are reaching new highs. Employment continues to chug along. Income growth is strong. And so what interrupts that cycle is it doesn't just fall on itself. What has to happen is we have to have a rise in bond yields. That rise in bond yields has to start to slow the asset price appreciation, and that has to start to shift the amount of demand coming from consumers. But the ordering matters. So that's why I like to say until rates rise, the Fed will not cut.
But Bob, the rates market has retested near-term highs without any demonstrative hit on the equity market. So are you talking about a more extreme pricing in bonds to the upside?
Yeah, I mean, just think about, if you just go back last summer, what we saw is we saw bond yields rise up to 5, and we only got a modest equity correction in response to that, and not nearly enough for long enough in terms of the rate rise to create a drag on the economy. Now, fast forward, we're basically, 9 months later, 6 to 9 months later, and asset prices are reaching even higher levels. There's even more positive momentum in the economy. We're seeing actually cyclical upticks in areas like manufacturing, global exports, et cetera. And so in order to get that slowing, at this point, we probably need to move yields back up to the 5 or even higher in order to slow the economy.
Bob, you're sort of trying to give people a little bit of a heart attack here. Jim, come on, join this. What's the risk of, well, I mean, I say that. If markets, could they retest 5%, Jim, in your view, in terms of a yield pop, if this inflation remains sticky? Have a look at 5-year break-evens, gentlemen, and to our audience this morning. Have a look at 5-year break-evens, because that's where the sticking point is for a lot of the swaps traders. The break-evens are perhaps underpinning Bob's hope that we will retest higher ground in yields. Jim?
Yeah, I agree. I think that we are going to do that, and I think that when rates go up, I agree with Bob, that the equity market or the risk markets will have indigestion. Now, one of the reasons that they don't have indigestion now, because you can argue we've gone from 380 on the 10-year note to about 420, is because of what just happened an hour ago. Chairman Powell says, I will cut rates later this year. And the stock market says, Okay, I'm not going to quibble about March or May or June. He says he's going to cut rates, start pricing it in. And 16 of the last 18 weeks, the stock market has been higher on this underpinning that we're going to see a rate cut. And we're going to see the competition from interest rates come down. Because I think one of the problems the stock market has with interest rates is the long-term prospect for the stock market is about an 8% return. And if you could get 5.3 in a money market fund, I think there's a lot of people who say, I'll take that with a $1 NAV every single day, as opposed to taking risk to try and get an 8% return. So if the Fed cuts rates, we could dust off the TINA argument again and try and push everybody back into the equity market. And that's what it's assuming is going to come. And later this year, if it winds up that the data's too strong and yields go up, I think that then it's going to run into that indigestion that it's not going to get that.
Well, look, I could do battle with you both all day. You know, Team Transitory was wrong. We then have people calling for rate cuts. Various super economists out there calling for earlier rate cuts. Bostic throws a kite up there of one cut and done. But I need to understand, if you're both saying the risk is actually for higher rates, I just wonder then what you make of this. This was a conversation we had with Amy Silverman this morning. In a post-COVID regime, the right-hand tail, right? So the right tail is the new left tail. Basically, the biggest fear for investors is that the upside, not the downside. Now, you're both giving me a view that we could test higher rates, but all the risk, all the momentum in this market is for, my gosh, I don't want to be left out of the upside. So Bob, equity market risk. Do you agree with Amy?
Well, I think if you look at the history of equity market expansions, the way in which equity market expansions end is that, you know, at elevated valuations, it's not because valuations are so high, it's because there's a tightening which pricks, you know, either a bubble or an elevated equity price. And so I think a lot of investors are seeing right now the consequences of the self-reinforcing positive dynamic that exists with an equity market expansion flowing back and reinforcing underlying economic strength. But without that prick, that can continue. And if you look back through time, getting short ahead of the tightening of monetary policy is a recipe for lagging the equity market performance for a long time.
Jim, I mean, this was quite a gripping narrative this morning on Bloomberg Brief, which is, I get it, it's weaponized FOMO. If you're not in, and I'm not in on NVIDIA, I'm not in on the Mag 7, whether it turns into the Mag 5, if I'm not pro-risk, I do run this real risk of getting left behind, whether it's in credit, whether it's in equity, or indeed, for that matter, Bitcoin or gold.
Oh, no, I think you're right. And I think that the Mag 7 has morphed itself into the Fabulous 4 as those stocks have just continued to power higher right now. And people are looking at it and wondering, you know, it's kind of a conflicting narrative because we've got the stock market going up and we've got everybody FOMOing into the stock market at the same time. We've got economists openly talking about the potential of a downturn, the potential of a soft landing or something worse, and that the Fed has to cut rates to respond to it. And those are, like I said, in conflict kind of stories right now. But I think that as the stock market continues to move forward, one other thing that was in that quote was about being a post-COVID economy. What we're learning about the post-COVID economy is the propensity to spend is much higher now than it was, say, from 2010 to 2020. So if the stock market goes up and gives you unrealized gains, you're going to spend more of it. And spend more of it is going to push the economy higher and is going to put a bid for prices, which is a fancy way of saying inflation's going to bottom and inflation might stay sticky. Because unlike 2010 to 2020, when the stock market went up, we were just satisfied that our brokerage statements were larger. Now we're going to use some of that money and we're going to spend it.
Okay, well, we need something to supplant perhaps the COVID rush that we had. Bob, Jim, stay with me. More work to do. Bob Elliott, Jim Bianco. My guest this morning, joining me now to look at the market ahead of this opening bell, 18 minutes to run, is Abigail Doolittle, as ever, every day. Abby, what have you got?
Well, let's start out with a big winner, and I'm talking about the stock that you were talking about earlier, CrowdStrike, up more than 20%. The cybersecurity firm put up a big top and bottom line beat. They also put up a forecast for both earnings and revenues that was better than what analysts had forecasted, and they are taking market share. This quarter that they just posted is in stark contrast to Palo Alto Networks, which really plunged. Palantir, the data company, up 9%. They won a $178 million contract from the U.S. Army for their tactical intelligence targeting access node. This is mobile ground stations powered by machine learning and, yes, you guessed it, AI. And then Estee Lauder down 2.3% off the lows, but nonetheless down on the news. The report that acne products in the U.S. are found to have a cancer-causing chemical in them, benzene. Some of this is apparently in their Clinique brand, Manus.
Okay, skincare is the alpha. Abigail, thank you very much, Abigail Doolittle. Coming up, Nikki Haley concedes as Trump dominates Super Tuesday.
There's never been one like this. There's never been anything so conclusive. This was an amazing night, an amazing day.
Inching ever closer to the Biden-Trump rematch. The conversation next on Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
They call it Super Tuesday for a reason. This is a big one. And they tell me, the pundits and otherwise, that there's never been one like this. There's never been anything so conclusive. This was an amazing night, an amazing day.
A Biden versus Trump rematch, it's all but set. Nikki Haley speaking at the top of the hour, where she's expected to suspend her presidential campaign following a rough Super Tuesday. The former South Carolina governor managing only a token victory in Vermont, with Donald Trump dominating in the other 14 contests. Anne-Marie Hordern joins me now with more. There's no irony that Nikki Haley won Vermont.
Well, no, that's the point, right? This was a token win, and she's obviously seeing the writing on the wall. She has no path. It's pretty much been this way, but she said she would go through to Super Tuesday, and she did. And now she is going to be backing out. One key nugget we learned from the Wall Street Journal reporting, Manus, is that she is not expected when she speaks from her home state of South Carolina, and she says, I'm no longer going to pursue this. She is not expected at that time to give her endorsement to the former president. And that is what everyone is going to be waiting on. The first question was, when is she going to back out? We have that answer, and now it's whether or not she is going to endorse the former president. And, you know, he really does need her endorsement in the sense, if you look at the voters she was able to pick up, you could see in some states, Trump is behind 40%. That's how much she is getting. To encompass the entire party, he needs to bring those Nikki Haley voters along, and that's going to be his steep climb as we head into November.
So that's about party unity. And if he needs to pick up these extra votes from her to carry the national vote. And you've pointed this out on a number of occasions. The challenge now is perhaps those undecided voters for both sides, actually.
The question is, those individuals who consider themselves Republican, but they don't consider themselves quote-unquote MAGA, and they liked what Nikki Haley was selling. She was not isolationist. She talked about the fiscal health of the United States. Do they go out to the polls and back former President Donald Trump?
Or do they stay at home as a protest vote? That's the other major risk, isn't it?
Yeah, and there's a risk as well on the Biden side. You know, obviously, he clearly was the winner last night. He is going to be the nominee going into November. But look what happened in Michigan. More than 100,000 individuals went out and voted uncommitted. The same happened to him last night in Minnesota. That was at 20%. He has a lot of work to do to shore up some parts of his Democratic base. We're likely going to hear him talk a lot about this tomorrow evening at the State of the Union.
You're off to Washington. We wish you well. We'll see you over the next couple of days. Anne-Marie Hordown changes venue and home, but not show. Bob Elliott and Jim Bianco are my guests this morning. Bob, Jim, here we are. You've got 9 months of this, gentlemen, to talk about political risk every day. So I just wonder if we step back for a moment and I say to you, fiscally, to me, both these candidates represent fiscal largesse. Bob, to you, first of all, it would reinforce your 5% call on yields if there really is a fiscal mandate coming, let's say, from the Trump house. But how do you think markets will inch towards the November election?
Well, I think they're probably not going to be particularly influenced by whether the election outcome is either favors Trump or favors Biden. There may be certain individual stocks that might benefit or not based upon the incremental difference in the policy, like higher tax stocks benefiting from a Trump administration. But that's pretty on the margin relative to the fact that both of these presidents, if they were to come into office, they're going to run very large fiscal deficits and be supported by Congress in doing so. And what that does is two things. It perpetuates a support to the macroeconomy and the continued strength.
Yep.
In addition to the fact of creating all that bond supply to fund those large deficits on an ongoing basis.
Yeah, well, let's see what the ratings agencies have got to say about that, depending on who sits on Capitol Hill. Jim, it's probably a bit too early, and I think you make this point, which is it's a bit too early to put together baskets of higher tax, lower tax companies, or is it?
No, I think it is too early. I agree with Bob that on a fiscal standpoint, they're both going to spend money, and that's going to make the economy stay strong, and that's going to keep the borrowing higher, full stop. Now, where they might differ is when you start getting into non-economic numbers, you know, whether or not you're talking about foreign policy or you're talking about the south border or something like that and how that might impact it. But then again, even if we start getting into those types of things, it's really hard to say one policy differs from the other. So here's a basket of stocks you'd buy one way, or here's a basket of stocks or what you would do with the bond market the other way. So right now, I don't think that this is really playing. I know we like to ask the question, is the Fed really playing in the markets? And the answer might be yes or no. I would actually turn that around and say politics really isn't playing in the markets. But again, it's still 9 months away.
If I said to the two of you, what is a gray swan event from the political spectrum? Bob, what would you say that could look like?
I think the main question is dysfunction and whether or not they can continue to operate the government in a time where we still have divided government and it may become more divisive heading into the election. And that could create second and third order consequences and a drag on the economy if they can't get things like budget and spending done.
And for you, Jim, what would you say could be a grey and disruptive emanating from political landscape?
That the two candidates that we assume are going to be the nominees, that one or both of them doesn't. One's on trial and might be convicted, and the other one is running behind, and his party is very, very upset or very worried that he can't win. and that we might see a change. You know, it's a low probability.
Jim, are those low probabilities very left tail risks?
Yeah, I think so. But I mean, they could really change. They could be very, very disruptive if you see one or the other or both winding up changing between now and, say, the conventions or election day. Low probabilities, but they're worth mentioning. They're still out there. You see them in the betting markets. The betting markets have got them, you know, that there's a non-zero probability that there could be a change.
Okay, well, certainly the two of you have given me food for thought in terms of where we can go with bond yields and non-zero probabilities. Bob, Jim, thank you very much. My guest this morning coming up in the show. Of course, your morning calls. We've got Boca Capital's Kim Forrest joining me saying AI, it's the real deal. That conversation next on Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal?
The Deal?
The Deal. The Deal. That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Wow. Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Time for your morning calls. This is what the analysts on Wall Street are saying. First up, Berenberg upgrades Honeywell to buy, highlighting a strengthening in the aerospace business and a compelling valuation. Morgan Stanley upgrades Progressive to overweight, expecting the company to steal at least 18% market share over the next 4 years. And finally, Deutsche Bank upgrades Target to a buy with the street high price of $206. Look at that, we're 171.20 and change at the moment. So another 20% upside there on improving traffic and good inventory levels. Coming up, Boca Capital's Kim Forrest joins me, unveiling the stocks most likely to benefit from the AI explosion on Bloomberg.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Why should somebody want to be in the pharmaceutical industry? Why not go into something sexy like private equity?
In the end, what we do is we create these miracles that fit in the palm of your hand, these little medicines that can transform a human being's life.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
It was a pause, not a panic yesterday. There you go. We're saved. We've got this nice, firm tone to the markets. We've had the prepared remarks from Powell. He's ready to cut rates. He wants a little bit more evidence, but he's not pushing back. He's not joining the Apollo Mizuho, along with my last guess, which is 0 rate cuts in 2024. That is a building narrative. Equities for the moment, NVIDIA, we're grand, we're up, we're bid. S&P 500 holding above 5,100. NASDAQ up over 1%. We gave back 1.8% yesterday on this mild whiff of exuberance that these markets were stretched. We're dealing with the elasticity of a rally, and whether you believe the rally that you have seen in Bitcoin, the rally that you've seen in gold, is enough to sustain the overall risk rally. Are you seeing a transfer, a rally in Bitcoin and other assets into the equity market? Look at that Bitcoin, up 5.8%, above the record again is where we're heading. And you have gold futures up 0.25%. Again, record highs. We had Schroeder's with us this morning talking about being long gold against that sticky inflation narrative. Yields dropped by 3 basis points. That is a mild reaction to Chairman Powell's narrative. One area that we're going to keep an eye on as ever, every day recently, are the U.S. retailers. It is earnings season. Nordstrom, Ross Stores, and Foot Locker all deliver disappointing results. Abigail Doolittle is with me. What gives with Nordstrom versus Nordstrom Rack? Good morning, Abby.
Well, that is the big difference for sure. And I should note that relative to the stock, we are looking at the worst day since 2022. Some of this has to do with a pretty significant bearish short interest. 18% of the float is short. But to your point on Nordstrom high end versus the Rack, the high end really not doing as well as the Rack. So some analysts are encouraged by the idea that the more discounted area, those stores, could be a bright spot in the future, but the overall forecast in the year, not so great, not a bright spot at all. They're looking for a range of -2% to up 1% versus the previous 12 months. And in fact, for the fiscal year that's starting now, that ends in January of 2025, looking basically at no growth, just down 1% on the top line and down 21% on the bottom line. So this quarter, this forecast, just not enough to get Nordstrom out of the range that it's been in over the last 12 months. Let's call it between about 14 to 24. Now over the last 12 months, Manus, on today's action, it is down.
Okay, Abby, thank you very much, keeping us up to speed on those retailers. Those were the laggards on the other side of the trade. I mean, CrowdStrike, what a belter. The shares rallying today, posting better than expected fourth quarter results. Alex Semenova joins me now. This is the cybersecurity company. Where are they outperforming, Alex? Good morning.
Hey, Manis. So investors clearly rewarding a set of upbeat results here from CrowdStrike. The stock was up as much as 25% in pre-market trading this morning, swinging higher here into the open. This is after the cybersecurity firm reported a forecast for revenue and profit this quarter that beat Wall Street estimates. CEO George Kurtz attributed this to a single strategy. That is that the firm offers all of its cybersecurity products on one platform, offering an integrated workflow, unlike rivals like Palo Alto Networks. In fact, during the call with investors, he flagged that Palo Alto Networks actually had been replaced by an unnamed financial services firm in a large seven-figure deal. Those were his words. This comes amid a volatile time for cybersecurity stocks in general. There have been an increase in cybersecurity attacks on firms. Some cybersecurity firms have capitalized on the opportunities while some have sat out. Analysts were really liking the results from CrowdStrike this morning. Morgan Stanley noted that CrowdStrike is one of the few software companies growing 30% this year. Piper Sandler said that the company is positioned to keep outperforming. Shares are up about 18% right now. That is the biggest intraday move since June 2019. And the stock was up 17% year to date through yesterday's close. Manis.
It's a heck of a run, isn't it? Alex, thank you so much. We're also watching Estee Lauder today, the company dropping after acne products from several brands are alleged to contain elevated levels of a chemical linked to cancer, according to a Bloomberg reporting. Simone Foxman has the scoop. Simone.
Yeah, this was a Bloomberg News exclusive from reporter Anna Edney, and it has to do with the results of tests a lab called Valisure, which is based in Connecticut, did on acne treatments looking for the chemical benzene. Now, the FDA allows 2 parts per million of benzene in products. It says that level is safe, but the lab found 12 times that amount in many common products for acne treatments. And then they tested, well, what would happen if you keep these creams at high temperatures for a long period of time, like what would happen in your bathroom if you leave that acne treatment near your shower and that becomes hot. And they found extraordinary numbers here. Estee Lauder's Clinique, for example, 401 parts per million. Taro Pharmaceuticals Proactive, 1,761 parts per million. Target product, also well above the limit. There's a $1 billion market for acne products every year. And, you know, Estee Lauder, for example, really leaning in to this space with its Clinique products, really wanted to double down on that brand, and that's what it said in its earnings call just last month. So this could be a really negative news headline for many of these companies. We're seeing shares pare back some of their earlier losses in the intraday trading, but more ahead on this story, Manis.
Okay, Simone, thank you very much. Good reporting there by the Bloomberg team. Let's get back to the earnings. Shares in JD.com enjoying their best day in over a month. That's after beating estimates and approving a $3 billion buyback. Let's get a little bit more with Isabel.
Hey, Manis, shares are rising up and around 15%. JD is recovering from a 5-year low, and it's really because the company reported earnings that beat estimates and a $3 billion buyback program that investors are cheering, as you mentioned, and also a 23% hike in its annual dividend payout. So lots of things to digest there. First, let's go to earnings. So JD.com reported a 3.6% rise in revenue. So this was helped by a broader product lineup and price cuts as Chinese customers become a little more price conscious. The company reported sales that came in at 306 billion yen. That's around $48 billion compared to an estimate of 300. And when it comes to the buyback program, this is where investors are really excited about. It's a 3-year program. It's matching the old one that they had, and it's really meant to ease worries that investors are having about the company's growth potential. But Bloomberg Intelligence said that even if we're seeing a 23% hike in its annual buyback, it may not really help because the competition could keep lowering retail profits and also offset the company's strong logistics gain. So the results came after its billionaire founder, Richard Liu, in December said that JD should get its act together and fix its issues. This involves poor merchant support and an overly pricey item list. So recall that in the past, JD.com used to focus more on big ticket items, think electronics and things like that. But recently, it's moved more towards cheaper stuff as retailers feel a little more pinch. As we all know, the growth of the Chinese economy is looking a bit uncertain with its property sector and all the other issues like deflationary issues. So it remains to be seen what happens there. But for now, it's a good day for JD with shares up around 15%.
Okay, Isabel, thank you very much. Well, the markets this morning are digesting the pre-release testimony from Jay Powell. Boca Capital's Kim Forrest weighs in writing this. We believe that the path to 2% to inflation at the Fed's 2% target isn't linear. That's because nothing in markets is linear. Kim, good morning to you. I suppose that's everything except NVIDIA. But let's step back for a moment. We've had the pre-prepared remarks. It's clear that Powell wants to keep the door and the narrative open to rate cuts, and yet I read more and more and have more and more conversations going, I don't know when they can start to cut, and I think they may not be even able to cut this year. Is that too severe a take? Do you think the road to rate cuts is still bumpy but open?
Well, I would take Chairman Powell at his word. On the way up, when interest rates were on the way up, he kept saying, look, we're data dependent. And I don't think he's any less data dependent on the beginning of going down in the rate cut cycle. I think the core PCE keeps falling, and that is in the right direction. I don't think he's going to wait for perfection to wait till the core PCE is at 2%. He'll start cutting sometime, and I hate to say this, soon. What does that mean? I'm saying maybe before June or July at the latest.
What do you think he needs, Kim, to pull that trigger? What do you think he needs to pull that trigger? Because he talks about confidence. I reflect back to 1995. That was a period of time when the Fed talked about carefulness. And again, Bostic flies the kite of only one cut this year and done. So do you think that we're going to morph from this confidence to careful narrative?
I do, because there's some other pressures. Like, we don't live in a vacuum. Europe's rates are probably falling. China is certainly falling. And you don't want to have this unbelievably high rate in America drawing in dollars and making the dollar too strong because of our interest rate, right? So I think that's the pressure he's feeling, and that it's likely a cut will happen before the presidential election gets really going.
Mm-hmm. Okay, so that happens. To what extent are these two things divorced? I'm talking about the outperformance of tech, which is driven by AI, which you say is going to be the biggest winner. So that outperformance endures even in a world where there's only one rate cut, Kim?
I think so, because it's the thing that is, it's momentum, right? We have momentum with not only regular people interested in AI, but mostly the people that spend, which is corporations interested in AI. AI is the thing that can and will give businesses productivity, and that's why they're going to invest in it, and that's where the tech dollars are going to go. So it's as easy as I can make it, that's why I believe this is going to be the hot thing. Now, it's not going to be linear, because nothing's linear, and investors are going to be disappointed that in the next 15 minutes, AI doesn't arrive. Yeah. And that's really the narrative about any kind of large tech rollout that we've seen ever in the history of the markets.
So then that, in many ways, justifies the $300 billion destruction in value that you've seen in Apple. I mean, that's the number, a 10% retracement. So we're in that kind of correction mode on Apple. Some people say to me that's a good cathartic moment. It shows you efficient markets. Other people are saying it's an AI corrective moment. When you see moments like that, how do you think, which justification is it for you?
I think it's a little bit of both. I mean, the dollars, new dollars are not going into Apple, right? Or at least they're going in only to support the price that we see. Apple doesn't have like a direct participation in AI, at least that's what investors think. Now, I think they're a little bit wrong. For consumers in the developed world, Apple is the product that everyone uses, and I think unless they really mess up, which I don't think they are, Apple will be fine in the long run. And by long run, I mean 3 to 5 years. I don't see any other product coming out to replace that. So it could be a node connecting to AI, which is in the cloud. And I think that's the way to think of it.
but new dollars are chasing NVIDIA and all kind of things that might be playing, that might get more dollars spent in the near future than Apple.
So, people waking up and they check their NVIDIA pre-market at 5 a.m., you get it on the IB. There's an invincibility to NVIDIA, and that will be predicated on the uptake on smart technology. You say, look beyond, look at the software, and actually, in fact, look beyond, look at Intel, look at AMD. So you're moving this narrative towards chips to a quasi picks and shovel. I know they're not quite picks and shovel.
Right.
But talk me through that thinking on Intel and AMD.
Sure. So these systems need a lot of processing. One of the reasons I was a software engineer, I worked in AI, and one of the reasons why it didn't work in the 90s is computing power was too expensive. And it's still kind of expensive, but not nearly what it was in the 90s, and data wasn't available. So we have both of those. That's why I have confidence in AI. But I also have confidence that the people building out these new systems need a lot of power, a lot of computing power. And if you can get close to NVIDIA performance at, let's say, half the price, you're going to use that. And that's why I like AMD and Intel, because I think they are building competitive products to what NVIDIA has. And NVIDIA's DNA isn't in offering cheap products. Never has been, and unlikely never will be.
I think my favorite line that I've had recently is, what is the poor man or poor woman's NVIDIA? One answer to that was Broadcom, but I think that you've broadened that spectrum for our viewers this morning. I think that's important about where the other opportunities are. Boca Capital's Kim Forrest, my guest this morning on The Markets. Coming up, a consumer under pressure shows up in the latest retail results.
I think the consumer is going to continue to be discerning. I think it's incumbent upon the retailers to deliver innovation and value in order to drive demand.
We'll break down the numbers. That's next on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well, because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
They are trading judiciously. They are looking for value. When you think about Nordstrom's results overall, you saw that the rack business, which is the off-price business, was up nearly 15%. It's the full-line business that was pressured. And in both areas, you saw beauty do well. In almost every single retailer, beauty is what's performing category-wise. But keep in mind, the guidance at Nordstrom kind of bracketed consensus, and it's going to be a margin-pressured year in 2024.
Nordstrom seeing a cautious consumer, forecasting muted revenue for this year due to the slowdown at the high-end stores. Ross Stores warning that the consumer is under pressure. The CEO writes this: while inflation has moderated, housing, food, and gasoline costs, they remain elevated. And therein lies the point. Simone Foxman joins me now on this story. Therein lies the point, Simone, that there is incremental pressure on the consumer, and it is differentiating between the high and the low end.
That's not what all these retailers saw in the fourth quarter, though, which is so interesting because pretty much everybody beating on their results on the fourth quarter. It's really the outlook looking ahead that is the problem. And it may be most pronounced in discount. You look at into the details of these Ross store results. Comp sales, 7% in the fourth quarter gain as opposed to the estimate of 2 3/4. But when you look for the year ahead, they're looking for 2 to 3%. The estimate was more than 3%. So I think the analysts class, the Wall Street investors want to see a little better, a little hotter outlook, even for these discount places, the places that people go when their wallet is tight. And they're just not seeing it at the moment, you know, talking those Nordstrom rack numbers that Dana was mentioning. And also at the higher end, you're seeing a lot of consumer weakness, whether you look at the broader Nordstrom business or you look into Foot Locker, which Bear described as having a low quality beat reflecting heavier markdowns.
Look, I'm looking at Abercrombie. It's a long time since I've been in one of their stores. It went through a real zeitgeist moment with a generation. It's down 4% at one juncture this morning. What gives at Abercrombie?
Yeah, what's so interesting here is that Citi called this an outstanding beat, an outstanding earnings result with sales and gross margins coming in well ahead of expectations. This appears to be a bit of a valuation problem.
Okay.
Abercrombie has turned itself around and is perhaps the best indicator, the company out there most showing that you can live in an environment where a consumer is a little bit cautious if you're constantly rolling out new stuff. I know I haven't shopped at Abercrombie in quite a while, but I've been recently looking at their jeans online because they look pretty awesome. Even there, though, the estimate for this year is looking at 4 to 6% comp sales growth, and executives acknowledging the instability on a macro basis. They're focusing on controlling what they can control, Manus.
Okay, Simone, thank you very much. And yeah, we're seeing combinations with Target and a number. I think this is a point that Abigail was making, Target with a number of designers. So again, it's about how do you build out the proposition. Simone Foxman with the very latest on the retailers. And some more price action. Let's get across to Abigail Doolittle. She can fill in the blanks. Abby.
Well, we are looking at pretty interesting sector composition here today, Manus. Right now, we have the S&P 500 up about 0.5%. One of the most defensive sectors, though, leading the way, that is utilities, up 1.4%. And of course, dividends there are big. So when yields go down, it makes those stocks look a little bit more attractive. We are seeing tech overall seeing a bit of a bounce back, up about 0.8%, even despite the fact that Apple has once again turned negative, down 0.5%. Interestingly, the financials are the only sector down just a little bit. And a piece of this is Morgan Stanley, down more than 4% on the day, the worst day since October. We are digging into what's behind that somewhat severe price action for Morgan Stanley. As for tech on the week, well, it's not quite a recovery yet. After yesterday's big sell-off for the New York, the NYSE FANG Plus index, we are looking at a decline of of about 2.7%. The day is young. Let's see whether or not there can be a little bit of a round trip there if those dip buyers show up, or maybe we're seeing some consolidation to the big recent gains.
Okay, Abby, thank you. Perfect chart. Really rounding out this hour on TV. Coming up, we'll give you the market moving events for the rest of your day on the Trading Diary.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Context is everything. Yesterday, it was a pause, not a panic. Look at this market this morning, supported by NVIDIA, supported by Powell. There's a lot of P's going on here. The narrative in Powell is the doors are still open to a rate cut. Yes, they need a little bit more confidence. Breadth of market, happy with the possibility of a rate cut. NASDAQ, reprieve with NVIDIA on the upside. And the S&P 500 garnering 0.5% to the upside. This is a market which is juggling the idea of no rate cuts through to 3 rate cuts. Your trading diary looks like this ahead of the week. JOLTS data comes in at the top of the hour. That's the main event. Chair Powell testifying at the House. We'll also hear from Nikki Haley. What are her plans as she exits the Republican presidential race? The risk is non-endorsement of Trump. What does that mean for the voters who stood behind her? Thursday, ECB decision, Christine Lagarde and her news conference, and of course Thursday night, President Biden, State of the Union address. What will the message be? Friday, it's all eyes down on the jobs report and the wages. That jobs report, again, reaffirming the strength and the unique capabilities of the U.S. economy. That's it for Countdown to the Open. Straight ahead with the rest of the team on Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Authorities
could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Alex Steele, Paul Sweeney, live with Bloomberg Intelligence. We'd like to focus on the research that the good folks at Bloomberg Intelligence provide throughout the next couple of hours, focusing on the BI analysts that cover 2,000 companies, 130 industries, and that's kind of what we try to do here at Bloomberg Intelligence. Today, a little bit of a hybrid day here. We're going to be taking some comments in just moments from presidential candidate Nikki Haley from Charleston, South Carolina, reportedly pulling out of the race. We also have Fed Chairman Jay Powell. He's going to be delivering a testimony before the U.S. House Financial Services Committee in a few moments. We will bring that to you in its entirety, and we'll set that up. Maybe check in with Ira Jersey, Bloomberg Intelligence, U.S. rate strategist, maybe get a little bit of a preview of what we might hear from Fed Chairman Jay Powell. So we got a lot of live programming coming up here with some interesting speakers, and we'll bring that all to you. First, let's kick everything off, Mr. John Tucker.
All right, we are a data-dependent, Paul and Alex, so let's get to the job opening labor turnover survey. A little lightness in the labor market. Job openings, 8.86 million in the month of January, almost right on with expectations, a little lighter than the previous month. Right now, technology leading markets higher, and of course, Fed Chief Jerome Powell, he's right now sitting down to testify before Congress in the prepared remarks. He says the Fed, no rush to cut interest rates. Investor sentiment continues to be in the driver's seat for these markets. At least that's according to Amy Wu Silverman at RBC Capital Markets.
Folks went in and bought more call options. That's the activity we saw across the board. And then the other thing we saw was people starting to sell puts in names like Apple, essentially saying they think that perhaps it's hit a bottom. So the sentiment continues to remain quite positive, even on days like yesterday.
All right, right now, S&P 500 up 24 points, a rise of 0.5%, 5103 on the index. The Dow Jones Industrial Average up 130 points, a rise of 0.3%. The NASDAQ 100 up 104 points, that's up 0.6%. Apple shares right now down about 0.3%, and shares of NVIDIA giving a lift to markets as well. That is up right now 2.2% in the early going. 2-year yield down 2 basis points. That's at 4.53. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Paul, and welcome back, Alex.
Thank you so much.
We missed you.
I missed you too, John Tucker.
Don't ever leave me alone with Paul.
Exactly. It was a little grim there. So you were down in energy country yesterday, right?
Houston, Texas, baby.
Okay.
Yes, I was. There was a Bloomberg New Energy Finance Summit where they talked about basically the transition, the future of transition here.
Yep. All right. Let's go right now down to Charleston, South Carolina. Republican presidential candidate Nikki Haley. Let's take a listen. She's standing at the podium. Here we go.
Just over a year ago, I launched my campaign for president. When I began, I said the campaign was grounded in my love for our country. Just last week, my mother, a first-generation immigrant, got to vote for her daughter for president. Only in America. I am filled with the gratitude for the outpouring of support we've received from all across our great country. But the time has now come to suspend my campaign. I said I wanted Americans to have their voices heard. I have done that. I have no regrets. And although I will no longer be a candidate, I will not stop using my voice for the things I believe in. Our national debt will eventually crush our economy. A smaller federal government is not only necessary for our freedom, it is necessary for our survival. The road to socialism is the road to ruin for America. Our Congress is dysfunctional and only getting worse. It is filled with followers, not leaders. Term limits for Washington politicians are needed now more than ever. Our world is on fire because of America's retreat. Standing by our allies in Ukraine, Israel, and Taiwan is a moral imperative. But it's also more than that. If we retreat further, there will be more war, not less. As important, while we stand strong for the cause of freedom, we must bind together as Americans. We must turn away from the darkness of hatred and division. I will continue to promote all those values, as is the right of every American. I sought the honor of being your president. But in our great country, being a private citizen is privilege enough in itself. And that's a privilege I very much look forward to enjoying. In all likelihood, Donald Trump will be the Republican nominee when our party convention meets in July. I congratulate him and wish him well. I wish anyone well who would be America's president. Our country is too precious to let our differences divide us. I have always been a conservative Republican and always supported the Republican nominee. But on this question, as she did on so many others, Margaret Thatcher provided some good advice when she said, quote, "Never just follow the crowd. Always make up your own mind." It is now up to Donald Trump to earn the votes of those in our party and beyond it who did not support him. And I hope he does that. At its best, politics is about bringing people into your cause, not turning them away. And our conservative cause badly needs more people. This is now his time for choosing. I end my campaign with the same words I began it, from the book of Joshua. I direct them to all Americans, but especially to so many of the women and girls out there who put their faith in our campaign. Be strong and courageous. Do not be afraid. Do not be discouraged, for God will be with you wherever you go. In this campaign, I have seen our country's greatness. From the bottom of my heart, thank you, America. God bless you.
That was, I guess we call former Republican presidential candidate Nikki Haley delivering remarks in Charleston, South Carolina, formally withdrawing from this presidential election.
And made it very clear that no one's to ask her who she's voting for.
Right.
Basically saying that that's a private citizen's right to vote for who she's voting for. And
what, no endorsement?
And clearly not endorsing President Trump. And I really wonder what that means. Is it a 2028 thing or is that a convention thing?
Yeah, I don't know. All I know is I think we're going to have to really pay attention to these conventions, particularly the Republican convention this summer. In the past, you can kind of blow by them and go to the the baseball game on, but I think you might have to focus a little bit this time. Let's check in with Josh Wingrove. He's Bloomberg White House reporter. Josh, you heard former Governor Nikki Haley's comments here. Any takeaways for you today?
Yeah, I think that was a sort of a polite sounding of the alarm. Her comment on it being up to Trump to earn support inside and outside the party is essentially a nicer version of what she's been saying on the stump, that Trump is, in her view, as of now headed for a loss. Of course, the polls show he's winning right now, but the big question throughout this primary is what happens to the 20, 30, 40% of state primary voters who've been voting for Haley. Do they vote for Donald Trump? Do they stay in the fold? Do they stay home? Do they back a third-party candidate? Some of them are saying they'll vote for Joe Biden. And so I think that she's sort of sounding the alarm a little bit. I wouldn't pay so much attention to the convention. Personally, I suppose it's a guess in any sense of the word here. I think Nikki Haley is staking out the I told you so ground, and that if and when or if Donald Trump wins in the fall, then Haley's place in the party wasn't going to be all that high anyway. If he loses in the fall, then she's the one that can say that she was loudly warning of that, and that sort of gives her inside track for at least a certain segment of the party in 2028.
Okay, so Josh, that makes it seem like it is a 2028 sort of thing, because there was a narrative for a second about the convention and trying to get delegates, and she just kind of show up and see what happens. You don't think that's a real thing?
I don't. Although I am curious whether she'll speak at the convention. I think a lot of us will be spending our times combing through the vagaries of the rules of the RNC to see whether she precedent would either sort of suggest she gets a speaking spot or not. This is going to be a tricky one for her. She's been pretty vocal in sort of her views of where Trump is going, and so to the extent that if she's there and sort of in the fold and speaking to suburban communities, those sort of voters that Trump has been losing, then that's probably good for Donald Trump. But if she's there sort of reminding everyone that there's in her view, sort of a five-alarm fire going on, then that's bad for Donald Trump. If you look at where she has performed well in the primaries, it is the types of areas where Joe Biden wants to perform well in the general election. It is suburbs, it is cities, and so the Biden people have been, Nikki Haley fans, essentially, A, because she's out there prosecuting a case against Donald Trump rhetorically on the election circuit, but B, because they think that her very candidacy was sort of reminding voters that they might not be Donald Trump voters.
All right, Josh, thank you so much. We appreciate getting some thoughts there. Josh Wingrove, Bloomberg White House reporter. Again, Nikki Haley withdrawing from the race, as I think a lot of folks thought she would after Super Tuesday.
Right. But it does really open up that 2028, and sort of I'm really interested in what those voters do. And if you don't have her at the convention, what's in it for those voters at the convention? Like, who's talking for them?
I don't know. I think it's, I believe we were talking earlier with Tom Keene, but this is Donald Trump's Republican Party now in every shape. I joked to John Tucker that if my father were alive, he'd vote for Richard Nixon. I don't think my father would recognize his Republican Party, but it is in fact changed, and it is behind President Trump. So we'll see how that plays out. Again, I'm going to pay attention to when they have these meetings this summer, these conventions.
Yeah.
So, all right. So we are waiting on Fed Chairman Jay Powell. He is slated to begin speaking in just moments in front of Congressional Committee. Let's check in with Ira Jersey. He's Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Ira, I think the Fed's been pretty clear on their messaging here. Kind of 3 rate cuts this year. That's kind of where the dot plots lead you. The market can, speculate as it likes, but are we going to hear Fed Chairman Jay Powell just kind of reiterate that stance today?
Yeah, so the prepared remarks have been out since 8:30, and it was absolutely nothing surprising in it. In fact, it wasn't even any nuance that was surprising, given that that statement that he's going to make formally in here in a couple of minutes is based on the monetary policy report that the Federal Reserve released last Friday. The important things to listen to, Paul, are things like during the Q&A session, what are they going to do with the balance sheet? How much are they concerned about that? Are there any scenarios that could arise that would make the Federal Reserve increase interest rates, right? The market has shifted pretty significantly recently to pricing for zero chance of a interest rate hike by the end of this year to around a 10% chance of one, right? So I think it's those nuances that could potentially be market moving, but that's going to come during the Q&A, not during his formal remarks to start off the testimony.
So having been so lucky to listen to so many of these, what you definitely get from congressional leaders is they're pushing their party line, like they're talking to their voters in these things. So you could definitely make an argument that some there are definitely going to say the economy's terrible, it's really bad, you have to cut fast, et cetera, et cetera. How does he talk about that? Because there is obviously still a portion of the economy that is very much struggling, even though the data overall continues to come in solid. And I'm wondering how he's going to walk that particular tightrope.
Yeah, that's always the challenge for the Fed chair, right? Because there's distributional effects of everything that's going on. And I think that what he'll probably say is something like, look, it's our job to look at the overall broad economy, and we know that inflation is hurting a lot of working families, so we need to get inflation down. That's our first priority. That's not much different than what he said in the past during the post-meeting press conferences. And then on top of that, say that he'll probably highlight that they seem to be fulfilling their other part of their mandate, which is the job market, right? You haven't seen a significant uptick really in the unemployment rate. You still have a lot of people being employed. You had 300,000 jobs created in the month of January, right? So all of those things are, I think, go in his favor. So he'll have to say something along those lines. But I agree. You know, today in the House of Representatives as well tends to be very there's not actually a lot of questions that are asked. It's mostly political grandstanding. I think tomorrow in the Senate you might have a more interesting and nuanced discussion around monetary policy, around balance sheet policy, around the economy in general. Like we have a little pool going on within Bloomberg Intelligence is how many times has he asked about fiscal policy today that he won't answer, right? Like those are the kinds of grandstanding that a lot of these members of the House of Representatives can ask about.
What's the over/under?
4, by the way, 4 questions on fiscal policy today.
Okay.
Yeah.
Very good.
I'll write that down.
So, Ira, it's a presidential election year. How does that figure into the calculus of one Jay Powell in the Fed?
Yeah, I think right now he doesn't want to have to think about it, but presumably if Donald Trump is elected the president, then, Jay Powell's time he'll wind up being a lame duck more than likely as Fed chair. I don't see Donald Trump reappointing Jay Powell, even though he was initially a Trump appointee. I was quite frankly a little bit surprised that Jay Powell was actually appointed by Trump, because I thought, Trump would pick someone who was a little bit more on the dovish side, given that Donald Trump thinks that interest rates should always be low and et cetera, et cetera. I mean, I don't agree with that sentiment, but that seems to be where a President Trump would likely go in the next Fed chair, find someone who's much more aligned with his own view of the world, as opposed to Jay Powell, who's just a middle of the road kind of, regular, everyday kind of monetary policy person. On the other side, if President Biden wins, I suspect that maybe Jay Powell has a pretty good chance of getting reappointed. So from a policy standpoint, that's probably what the election is going to matter to the most. And then the other things that I'm going to be looking for this presidential year is going to be, what fiscal policies are going to be enacted, because obviously Donald Trump, when he was elected in 2016, he was able to implement a lot of his policy because Congress was basically on his side, whereas this time it looks like Congress is likely to be split. So it'll be a little bit more difficult for him to get a lot of his policies through if he is elected and we have that split Congress.
And just we're awaiting Jay Powell speaking before the House Financial Services Committee. Here he is right now. Thanks, Ira.
The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward these objectives over the past year. While inflation remains above the FOMC's objective of 2%, it has eased substantially, and the slowing in inflation has occurred without a significant increase in unemployment. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals have been moving into better balance. Even so, the committee remains highly attentive to inflation risks and is acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. The FOMC is strongly committed to returning inflation to its 2% objective. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. Economic activity expanded at a strong pace over the past year. For 2023 as a whole, gross domestic product increased 3.1%, bolstered by solid consumer demand and improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains relatively tight, but supply and demand conditions have continued to come into better balance. Since the middle of last year, payroll job gains have averaged 239,000 jobs per month, and the unemployment rate has remained near historical lows at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers, particularly among individuals aged 25 to 54, and a continued strong pace of immigration. Job vacancies have declined and nominal wage growth has been easing. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. The strong labor market over the past 2 years has also helped to narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past year, but remains above the FOMC's longer-run goal of 2%. Total personal consumption expenditures prices rose 2.4% over the 12 months ending in January. Excluding the volatile food and energy categories, core PCE prices rose 2.8%, a notable slowing from 2022 that was widespread across both goods and services prices. Long-term inflation expectations appear to have remained well anchored, as reflected by a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. After significantly tightening the stance of monetary policy since early 2022, the FOMC has maintained the target range for the federal funds rate at 5.25% to 5.5% since its meeting last July. We've also continued to shrink our balance sheet at a brisk pace and in a predictable manner. A restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. We believe that our policy rate is likely at its peak for this tightening cycle. If the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economic outlook is uncertain, and ongoing progress toward our 2% objective for inflation is not assured. Reducing policy restraint too soon or too much could result in a reversal of progress we've seen in inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the policy rate, we will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-run inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you, Chairman Powell. And I should have noted this at the outset, but this is your 25th testimony before the U.S. Congress as Chair of the Federal Reserve, and we thank you for your service and your commitment to congressional oversight. Very much appreciated. I'll now recognize myself for 5 minutes for the purposes of questions. Let's begin with what's top of mind. We had two issues that are top of mind with the Fed: regulatory policy, with the Barr proposal, the Michael Barr proposal on capital, and interest rates. We're in a political year, and the lens of a political year falls heavily on all government, all parts of government. There's a lot of debate about the past 3 years of high inflation and the impact on American families. And now that inflation is receding, there's been a great deal of speculation about when the Fed would cut rates. Some say that it's going to be a lot of rate cutting this year. Some say none. What say you?
I say that really it will depend on the path of the economy. Our focus is on maximum employment and price stability, and the incoming data as they affect the outlook, and those are the things we'll be looking at. I can go further if you'd like.
So at what point will the Fed be forced to cut rates? What does the data, what kind of data would you point to, and do you have any updates there?
What we've said is that the committee would like to see more data that confirm and make us more confident that inflation is moving sustainably down to 2%. We have some confidence of that. Inflation, headline inflation has moved down more than 3 full percentage points now to 2.4%, as I mentioned in my remarks. We want to see a little bit more data so that we can become confident and so that we can take that step of beginning to reduce policy rates. It's a very important step. We think because of the strength in the economy and the strength in the labor market and the progress we've made, we can approach that step carefully and thoughtfully and with greater confidence. And when we reach that confidence, the expectation is we will do so sometime this year. We can then begin dialing back the restriction on our policy.
Well, let's pivot to regulatory policy. Chair Powell, as you know, there have been serious concerns expressed on both sides of the aisle and across America and across industries about the Basel III endgame proposal that Vice Chair Michael Barr has proposed and that the Fed is taking up. The concern is on both process, meaning how the proposed rule was developed, analyzed, and released for comment, the general concern of a lack of economic justification for these actions, but also on the substance. The proposal goes much further than the Basel III committee recommended on capital requirements, putting us at a great disadvantage internationally, potentially. So my first question is on substance. Is the Fed listening to these comments that have been nearly unanimous in opposition to this rule? Is the Fed listening to these comments on the impact the rule will have on everyday Americans? And what is the status on rulemaking, and what is the plan moving forward?
So you're right. We've received voluminous and very substantive comments, as well as the quantitative impact study that we put out. We got those responses in mid-January, and we're carefully analyzing them. We had asked for very specific, detailed, data-based comments, and I'm happy to say that we did get that. So we're just now reaching the stage where we can begin to make decisions about how to proceed. We really haven't made any decisions yet, but I think I can say a few things. First, we do hear the concerns, and I do expect that there will be broad and material changes to the proposal. I'll add that I'm confident that the final product will be one that does have broad support both at the Fed and in the broader world. As far as process is concerned, we're really not at the stage of making decisions about that. That's down the road at least a bit. I will say the question we get is re-proposal, and I will say that we haven't made that decision, but if when we get to that point that turns out to be the appropriate thing, we won't hesitate to do it.
You won't rule that out? You would not rule that out at this stage of the game, re-proposal?
Not at all. No, I think it's a very plausible option. It will depend on how things lie at the time when we reach that point.
Okay. And there's a lot of concern about the interplay between different parts of the rule. And if you change one, what does economic analysis look like for the new proposal? So it is good to hear that you'll be methodical and the Fed will do its traditional role of building consensus around the substantive changes. And that is your intention.
That is right. I said this would be a thoughtful, deliberative process. It's more important that we get this right than that we do it fast. We understand that. This is an important rulemaking, and it's going to have potential implications for the economy and the people we serve. We're going to take our time and do it right.
Thank you, Chairman Powell. The ranking member, Ms. Waters, recognized for 5 minutes.
Thank you very much, Mr. Chairman. Chair Powell, I want to talk to you about housing, but before I get there, let me address the issue of mergers. Last week, I led a letter along with 15 committee Democrats to you as well as DOJ, OCC, and FDIC, expressing my strong concern about the lack of progress you have made in updating your bank merger review procedures. This is critical now that we just learned of another mega merger involving Capital One and Discover, which would create the 6th largest U.S. commercial bank with a major role in the credit card market. For far too long, experts have raised alarm that there is a rubber stamping process of bank mergers where virtually all applications are approved. All the while, unbridled market consolidation poses great risk to consumers and entrepreneurs. What is the status of your updates to the merger review process? And does the Fed plan to convene public hearings on the Capital One and Discover merger?
So I believe we're in regular contact with the Justice Department on what's going on with their review of merger practices. We're looking at that and considering. I think on the potential merger with that you mentioned, we haven't received an application, so there's really not much to say yet. It's early days. When we do get that application, though, we're going to evaluate that merger as always under the factors laid out under the law, and that's our commitment.
So you do believe that your bank merger procedures are ready to do the work that's necessary when you evaluate this possible merger?
I do.
And are you supportive of organizing community hearings on this merger?
I haven't talked about that with anybody. I will say this: we've done that in many large mergers, but that's not a conversation we've had yet. We literally don't even have an application for the merger yet.
Thank you. We'll stay in touch with you on that. So turning to the national affordable housing and homelessness crisis, where we've seen steady increases year after year in home prices and rent costs, which are a symptom of the chronic undersupply of affordable housing. Indeed, more renters and homeowners are now spending more of their income than ever on housing costs. And as you know, housing costs continue to be a primary driver of inflation. Do you think the Fed has sufficiently emphasized the role that housing costs play in keeping us from your 2% inflation goal? Do you think it's reasonable to believe that monetary policy can accomplish this goal without a fiscal policy response? And if you do, how long will it take to get there?
Housing services inflation is one of the 3 components that we look at that make up the core PCE and index. And it has been coming down from its heights of a couple years back. It's part of the story. I think the overall story is that goods price inflation has turned negative. Goods prices are actually coming down a bit. Housing services inflation, you can see from currently entered into leases that as leases turn over, the increases are going to be smaller. So in our forecast and in everyone's forecast, housing services inflation comes down.
It's been reported that the methodology used to assess housing costs as an indicator of inflation is imperfect, namely because it considers costs based on both new and old rent, including for owner-occupied housing on a month-to-month basis. This results in stale data since families' housing costs typically do not change unless they move or their lease is up for renewal. So to address these imperfections in the housing cost indicators, the Bureau of Labor Statistics and Cleveland Fed created an improved methodology based solely on new lease rents, which is referred to as new tenant repeat rent rent index. Has the Fed incorporated this new indicator into its economic assessments? If not, why not? And so, what changes has it had on the level of housing inflation observed by the Fed?
So we're well aware of that, and we do incorporate it into our thinking. As I was starting to mention, that is the reason, the fact that market rents are moving up at a much slower pace is the reason why forecasts are for housing services inflation to come down, and that absolutely plays a role in our thinking.
Thank you, and I yield back.
Jolly yields back. The Vice Chair, Mr. Barr, I'm sorry.
Wrong Vice Chair.
Wrong Vice Chair. The gentleman from Arkansas, the Vice Chair of the full committee, Mr. Hill is recognized for 5 minutes.
Thank you, Chairman. I want to welcome you, Chairman Powell, to the committee. We're glad to have you back and your expertise. And I want to pick up where Chairman McHenry left off on his conversation about Basel III Endgame. You made a good point saying you're not taking the whole concept of reproposal off the table as you review the analytics, and you all discuss the interactivity of that rule with other rules. So if you were to repropose the Basel III Endgame, would the Federal Reserve delay then the long-term debt proposal that's on the table? In other words, would you agree that the agency should not finalize this long-term debt proposal for bank holding companies until banks have a better understanding of what their capital obligations under Basel III Endgame might be?
So we haven't made the first decision yet, so it's hard, I couldn't say definitively, but yeah, that's a question we'd be asking ourselves is what would be the implication for other rules, including the long-term debt?
Well, and is the Fed considering changes to the requirement for regional banks to issue long-term debt? Right now, it's stated to be issued at 6% of risk-weighted assets, in abundance of caution in case there needs to be a resolution. Obviously, we know the logic for it. But as I understand it, it's being required at both the holding company level and down at the bank level, and that seems redundant to me. Are you aware of that, and have you considered changing that in your discussions?
Yeah, so that's another area where the comment period ended a little while back, and so once again, we're in the process of evaluating the comments. There will be a thoughtful, deliberative process around that. We welcome comments on these kinds of things. They're very important implications for the banks that are affected. We want to understand the effects, make sure we understand them correctly so that we can evaluate, what a final rule should look like.
Good. Let me turn to the monetary policy outlook. As the chairman noted, consumer prices are 17% higher for American households since President Biden was inaugurated back in January of 21. And yet, in spite of that 17% increase in cost, real wages have actually fallen 2% over that period. So there's no doubt that inflation is the biggest issue facing American households, and in my view, there's three principal causes. Certainly, we had supply disruptions, but we've had unprecedented fiscal policy laxity. You described it in a recent interview as unsustainable, but we also think that the Federal Reserve, in my view, and many people on this committee commented, should have reduced accommodation after the pandemic sooner. One of the things coincident with that, which is what I want to talk to you about, is that the FOMC announced in August of 2020 this flexible average inflation targeting framework right in the middle of the pandemic, which many of us didn't understand why the Fed would take that decision then, but it would give you flexibility on the 2%, saying the Fed could allow inflation to rise above 2% and stay there above that level for some time because the Fed had such challenges in getting the price level to 2%. That was a major shift in the Fed's approach. Do you think, in retrospect of now what we've witnessed over the past 4 years, that was a mistake in hindsight to change that framework, and is it under review?
So we said we would do a review on a 5-year basis, and that means we'll be starting that review toward the end of this year. So we really haven't started. I do think that the question you raised will be one of the questions we look at. But the bigger question really is that change in the approach was really based on the fact that we'd had very low interest rates and very low inflation for a long period of time. And policy was always very close to the effective lower bound, so there wasn't any firepower for central banks. And so it was a way to keep inflation expectations anchored at 2% and not have them slide down. Now we have entered a different period. The pandemic really may have changed that in a sustained way. We don't know that yet, but that's the big question we'll be asking ourselves is the effective lower bound to be thought of in a different way now? And if it were, that would have ramifications for our framework. But we haven't begun the review yet. It'll begin at the end of this year and probably end late the next year.
Thank you. Yield back, Mr. Chairman.
Gentleman yields back. We'll now go to the gentleman from New York, Mr. Meeks, for 5 minutes.
Thank you, Mr. Chairman. Thank you, Chairman Powell, for being here. And I think I want to pick up a little bit right where we are. 2019, 2020, the entire world was under the unprecedented pandemic with COVID rate. Is that correct?
Yes.
At the time. And that changed a lot of things with reference because not just for the United States, but for the entire world. And it affected the economies of countries just about on the planet. That's not also correct?
Yes.
And supply chains were disrupted. In fact, I can remember many Americans and people around the world could not get toilet paper or paper towels and some of the basics. And so the prices, because of the of supply and demand, skyrocketed, causing the inflation, not only in the United States, but basically all over the world. Is that correct?
Yes.
And so therefore, the Fed had to do certain things because of what we were in at that particular time. We couldn't just go back and act like the pandemic wasn't there. We had to do something to try to make sure that we were able to get through the pandemic. Is that not correct?
Yes.
And now we're at that point where we're about to get through this pandemic. And we can look at the rest of the world, what they did or didn't do at that time, but what we did at that time. And as a result of that, 3 years post the pandemic, when you look around the world, I think that you were correct with what you stated, that by most accounts, our economy is doing well. In fact, I would say our economy is doing better than most of the other countries in the world. Would you say that's correct?
I would.
And so, I would say then that some of the other countries of the world maybe should have looked at the policies that we put in place thereafter so that they could get out of it, so that they could have a labor market that is strong, where the unemployment rate is near a 50-year low. And as you've stated, inflation is also now coming down faster than any place else on the planet, just about. Is that not correct?
I think that's right, yeah.
And I think that you also recognize a mismatch between the strength of the economy, that's what we're talking about, in the field. And I think that Ranking Member Waters touched on one of those big issues of housing, of which is now, we're still trying to get that under control. And I think the Ranking Member has some ideas on how we can do that, and that may be something that you need to consider so that we can further get down the inflation rate. And the other would be the commodity markets, because the cost of food is too high in people. So that's something else that we need to get in control. Is that not correct?
Yes.
And let me just ask this. Can you say that there's a connection, for example, between conflicts in other areas of the world, like Russia's war against Ukraine and or the turmoil in the Middle East and the economic pressures that the United States feels? Does that not also go into the reason why the cost of commodities can be still higher? Is there a connection therein, Mr. Chairman?
Certainly the war in Ukraine caused commodity prices to move up sharply.
So could you tell you what is the, what would the connection lead you to believe that there is an urgent need for us, I would think, for, when we're running out of time, for us to do everything that is in our power in Congress to support Ukraine so that we can make sure that and other strategic partners, that we can help the commodities market, and that would help lower the cost of some of the commodities, bringing food prices down, if we would just be able to pass certain things that's going to help Ukraine right here in the United States Congress. Is that correct?
Here's where it gets outside of our jurisdiction. So I wouldn't have an opinion on Ukraine funding.
But if we had more grain that was going through, it wasn't blocked by Russia, things of that nature, that generally just, says that helps bring the cost down. Cost is higher because of the disruption in the Black Sea that's happened because of this war. So that would help bring the cost down. That is not necessarily the policies just here in the United States, but that's the policy because of what's going on in Russia, and we need to make sure that we do something to prevent that if we really are serious about bringing inflation down. Is that not correct?
I think it's correct that a full supply of grain would help with commodity prices.
And so, instead of us playing politics with this and acting like it is your fault or anyone else's fault that we had to go and do what we did because of the unprecedented pandemic, what we did was save the economy then, knowing we got some problems that we had now, and now we are recovering quicker and better than any other country on this planet as a result of your policies and the policies of Joe Biden.
The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Mr. Chairman. And Chairman Powell, thank you for testifying today. When you were before this committee a year ago, I cautioned against raising capital requirements on commodity derivatives that our agricultural and energy producers use back home to keep prices of food and power stable for consumers. At the time, you said that was a very specific concern and you weren't sure the proposal would even address commodity derivatives. And in fairness, that was before the Boswell proposal was officially published. Unfortunately, we now know that the proposal does impact commodity derivatives, and in fact, they are among the most penalized financial products that banks offer. And I would note for just a moment, I very much appreciate your comments and responses to Chairman McHenry about the nature of the overall proposal. Congress wanted end users to be able to secure their hedges without posting margin to keep the derivatives markets affordable. But I've seen estimates that some of these types of transactions for end users could face 10 times the capital requirement. Chairman Powell, make me feel a little better. Ease my concerns here. Will you and the Fed work to fix this?
Let me start by saying I want to echo the fact that our commodity markets and our capital markets are a huge national asset, and we need them to be functioning well and with as little friction as possible. I now understand that what you're referring to is the things that were done to increase capital requirements for various kinds of derivative activities. And I'll just say that's an area we're aware of the concerns, and it's an area that we're taking a very close look at.
I appreciate that. I was a member of the Dodd-Frank Conference Committee, where there was bipartisan support to not disadvantage end users, farmers, ranchers, small businesses. This had broad bipartisan support then and still does today. Unfortunately, the Fed could undermine this long-standing work done by Congress. I'd like to enter a few letters into the record, Mr. Chairman, that discuss the detrimental impact to end users. First, a joint Agricultural Trade Association letter from the American Farm Bureau Federation, the National Cattlemen's Beef Association, among 7 others. Next, a joint Energy Trade Association letter from the American Gas Association and 4 others. And lastly, a letter from the American Public Power Association and the National Rural Electric Cooperative Association.
Without objection.
Thank you, Mr. Chairman. Chairman Powell, I'd now like to focus on how the proposal is set to significantly disincentivize banks from offering clearing services. In Dodd-Frank, Congress mandated central clearing as a way to reduce risk in the system. The number of banks that can clear derivatives for end users has reduced over time, making it harder for end users to find a bank to offer this service. There are some estimates that the Fed's proposal will increase capital for this activity by 80%. I'm worried that this will make it even harder for end users to find a bank to clear their hedges. This also comes at a time when the SEC, our friends at the Securities and Exchange Commission, has just finalized a rule in December that will increase clearing in cost in Treasury markets. This will have a real impact on market access and liquidity, not just in commodities, but the $26 trillion Treasury market that plays a critical role in the world economy. Will you work with the CFTC to address this problem?
Again, I'll say that we're aware of those concerns, and we're prepared to work with other agencies and also to make sure that our capital proposal appropriately addresses them.
The strength of central clearing is entirely dependent on banks' willingness to participate, and problems with the Boswell endgame warrant a full reproposal to give us time to appreciate their consequences. And there are real consequences, as you and I both know, Mr. Chairman. And with that, Mr. Chairman, I yield back the balance of my time.
Gentleman yields back. The gentleman from Texas, Mr. Green, is recognized for 5 minutes.
Thank you, Mr. Chairman. And welcome again, Mr. Powell. It's an honor to have you before us today. I always enjoy hearing your commentary. As you know, recession and inflation, these are buzzwords, and they are used in some circumstances to
All right, we're listening to Fed Chairman Jerome Powell as he testifies before the U.S. House Financial Services Committee in Washington, D.C. Let's get back to it.
To end some of these troubling circumstances we're dealing with. Are you now at a point where you believe that there will not be a recession? There was much talk about recession, and many people worried that we would find ourselves having to negotiate our way out of a recession. What is your position currently on a recession?
So U.S. growth last year was in excess of 3%. What we're seeing so far this year is continued solid growth. My expectation, and that of other forecasters and of my colleagues, is that we'll see continued growth at a solid pace. I will say, so there's no evidence, there's no reason to think that the U.S. economy is in or in some kind of short-term risk of falling into recession. Having said that, though, there's always a possibility, a meaningful possibility that an economy will fall into recession. I don't think that possibility, though, is elevated at the current time.
Thank you. I appreciate you saying this because we want to, at some point, eliminate the great deal of fear associated with just the term recession. Next point, the December FOMC projections showcase a slightly lower unemployment rate than last June's projections and slightly higher GDP, suggesting a soft landing remains likely. Are you of the opinion that we're headed to a soft landing, Mr. Powell?
I'll just say that what we've seen so far is an economy that's growing at a solid pace. We're seeing a labor market that is still tight, still strong. Wages are moving up, but the labor market's coming into better balance between supply and demand. And inflation has come down sharply, really, since the middle of last year. So those are the conditions we see. They're very attractive conditions, and we're trying to use our policies to keep that growth going and to keep that labor market strong while also achieving further progress on inflation. That's our goal. And I think there's a possibility we can achieve all of that while keeping the labor market strong and the economy growing? Yes, I think there is a possibility. Indeed, that is what we're trying to achieve.
A soft landing can be difficult to identify. We could possibly have a soft landing and miss the point at which the landing took place. How do you define the soft landing such that a member of the public, a layperson, would understand that we have indeed had a soft landing?
So we really think about it in the terms I just discussed, which is we want to keep the economy growing. We want the labor market to remain strong. 3.7% unemployment is pretty near 50-year historical lows. And we want inflation to continue to move down closer and closer to that 2% objective. And we've made quite good progress on that over just the past year. So we want to continue those conditions. And I don't want to put the label on it. Other people can do that. But I would just say we're using our tools to keep a strong labor market and strong growth while making further progress on getting inflation down to 2% for the benefit of the public. That's the economy that we're trying to achieve, and I think there's we're on a good path so far to be able to get there.
Well, I concur, but I would ask this as my last question. Will there be some announcement at some point that we've had a soft landing? Because we have people who are continually indicating that we're not having a soft landing. There's a possibility of a recession. So will there ever be some official statement that would give people some comfort?
I don't think by us, no. I think we're just going to keep our heads down and do our jobs and try to deliver what the public is expecting from us. We wouldn't be, declaring victory like that, but
the gentleman's time has expired.
Thank you, Mr. Chair.
Thank
The
you.
gentleman from Texas, Mr. Sessions, is now recognized for 5 minutes.
Mr. Chairman, thank you very much. Chairman, welcome back. I think we enjoy this. I hope you do too. I know there's some bit of trepidation about all the things that are available to us and you to answer. I learned a long time ago on a campaign trail, every problem can be solved on a campaign. Reality is a little bit different. Welcome back despite all that. Looking at the Monetary Policy Report, March 1st, 2024. And as I review this, I would like to focus on the term that I would say high prices are here to stay. Because what I've heard you say today in this report really go to is you got everything under control, but we're going to keep the high prices. And I think the high prices really take a toll on the American people, as you're hearing from our colleagues, no matter whether they be Republican or Democrat. Page 7 of your report, you don't have to go focus on it, says, while current services, core service price inflation has been slowing, but remains elevated. It does. Labor costs, as you know, and energy costs are a driver to your monetary policy. The question that I have is, because you began referencing policy, 2 weeks ago or so, the president announced that he was going to slow down the gifting of opportunities in Texas for natural gas to be able to continue the exploration. And this in Texas is a $1 trillion problem to us, because if we do not constantly go find through these new finds, but also through the permitting process, we're in trouble. But we're also putting in trouble our contracts that we have with Germany and a lot of other countries. This is going to mean also that business in America continues to have high prices because, as you know, wages are already high and now energy is high. There's no resiliency to continue this and see the American people win. You talked about policy. So what's your advice to policy about energy and what this administration is doing on a policy perspective?
We have, broad, significant, important responsibilities, but we're really not responsible for energy policy, and we try to avoid commenting on.
But it has a huge impact on this report. It arbitrarily keeps prices high. It arbitrarily means that business is not, while they're making money, and while households, people do buy that, it's diminishing their long-term advantages to make progress. So you're just going to leave that alone?
Really not appropriate for us to comment. On if I'm commenting on energy policy, I should comment on everything. We have a mandate which is maximum employment and price stability. We take decisions by the legislature and by the administration as a given. We're not in charge of second guessing them. It's just not our job.
Okay, well, all right, let's say we're not going to second guess them. I will. I believe that the energy policies that this president and the Democratic Party have supported are causing a huge boom in prices staying high. They will not come down. A boom in attacking the energy industry, jobs that are associated with it, our foreign policy as it relates to contracts that we have signed with foreign countries, giving up the natural gas market almost entirely on a world market to Qatar. It has a huge impact on whether we are going to keep prices high or control these prices. It has a how many jobs get filled, whether we have jobs in place, whether we continue to have more jobs available than workers that are there, because over-regulation is having a lot to do with the nervousness, not only on this panel, but also by the American people. It would be my hope that you would pass some sort of a memo and tell them you have no opinion, but you want them to see what the impact is. I want to thank you for being here. Thank you, Mr. Chairman. I yield back my time.
Gentleman yields back. The gentleman from Connecticut, Mr. Himes, is recognized for 5 minutes.
Thank you, Mr. Chairman, and Chairman Powell, thanks for being with us today. I have a question, but I want to start by acknowledging, not celebrating, but acknowledging what has been a really remarkable soft landing in our economy. And I'm not celebrating because the American people, consumers, are still feeling the effects of high prices. Wages haven't caught up with prices in some instances. But I think that it would be fair to say that observers would never have predicted the conduct of this economy. You yourself said it in the final press conference of 2023 when you said a very high proportion of forecasters predicted very weak growth or a recession. Not only did that not happen, we actually had a very strong year. So I want to acknowledge that and acknowledge your commitment to independent monetary policy. And because I'm still burdened with this idea that truth and facts matter, I want to point out, especially having listened to my good friend Mr. Sessions talk about the energy market, truth and facts matter. We are producing more oil and natural gas today than any other country on the planet. We are the world's #1 energy producer. I could spend my entire 5 minutes sort of pointing out facts. The fact I want to point out here, and this comes right out of the report, is that the premise that inflation is Joe Biden's fault, is fiscal policy's fault, first is faulty because half the fiscal stimulus that occurred in the face of the pandemic happened under the previous president, Donald Trump, and it has faded. And this report makes the case. Core, and I quote from it, core goods prices have been declining as supply bottlenecks ease and import price inflation falls. So, Mr. Chairman, I don't want you to comment on that because it gets a little bit political, but I do think it's important that we keep some foot on the plane of facts. I do want to ask you a question, though, Mr. Chairman, because I always worry about risks that we see and risks that we don't see. And I want to use the remainder of my time to talk about a risk you're very conscious of, which is the overhang in the commercial real estate market. As you know, the Financial Stability Oversight Council identified commercial real estate as perhaps the most salient risk to the financial system, $6 trillion roughly in loans, half of that on bank balance sheets. In a 60 Minutes interview a few weeks ago, you characterized distress in the commercial real estate market as sizable but manageable. Do you still feel like that risk is manageable? Do you feel like you've got the visibility and the transparency and the tools to address it? It makes me nervous because this has echoes of 2008, 2009, when vacancy rates were declined relatively rapidly. We're not seeing that right now. So how do you feel? Does that risk continue to be manageable, and do you have the tools to manage it?
Yeah, I would say yes to that. I think it is manageable, and we've been working hard to management for some time now, really. And what it really is it's a lot of downtown real estate where there's too much office supply because of work from home, and also the kind of downtown retail that is no longer as profitable, and things like that are really at the heart of it. So what we've done is we've looked at banks that have significant concentrations, and we've been in touch with them to make sure that they have a plan to deal with that. There will be losses by some banks. It isn't really the big banks, it's really medium and small sized banks that have these higher concentrations. It's going to be with us as a problem we'll be working through, I think, for several years. And the idea is you've got to have enough capital, enough liquidity, and a plan to take the losses that you're probably going to take. And so that's what we're doing. We're very active in this space with small, medium-sized.
So let me ask you about that. Sorry to interrupt, but let me ask you about that. Silicon Valley Bank, wild irresponsibility inside the bank, egregious irresponsibility on the part of corporate treasurers who put so much on deposit. the Fed also had some self-examination to do because the examiners and the supervisors of the bank, quite frankly, were not doing what they should have been. So we might be forgiven for being a bit skeptical of claims of being on this. What has changed in the context of Silicon Valley Bank that gives you the confidence that the supervisors and the examiners will be on top of this?
I see it with my own eyes, but you know, I mean, frankly, there's a risk that we would overreact to something as significant as that. It's not like we wouldn't have reacted very, very strongly to what happened with Silicon Valley Bank, and we have. So I know that our supervisors are out there, and we're hearing back from media reports that we have been engaged with medium and small size banks principally on this. So I am confident that we're doing the right things there, and I do believe it's a manageable problem. If that changes, then I'll say so.
Thank you, Mr. Chairman. Yield back.
The gentleman from Missouri, Mr. Lukemeyer, is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Mr. Powell, for being here today. I'd like to associate my remarks, or myself, with Mr. Hill's remarks earlier with regards to the FDIC proposed long-term debt requirements that are based on the risk weighting of assets. I think it's an ill-thought-out proposal, and hopefully your position on FSOC, you'll be able to advise them and hopefully guide them that this is going to be held up until we actually get a Basel III rule. In October 2023, the board issued a proposal to update the debit interchange fee cap and regulation II. This is very concerning, given the data from both the GAO and Fed's own studies show that Reg II has significantly harmed access to free checking and other banking services for the country's poorest citizens. Yesterday, I introduced the Secure Payments Act, which would prohibit final rulemaking until the Fed, among other things, studies the impact of the board's proposed rule, completes a quantitative impact analysis specifically as it relates to affordable banking services for low-income Americans, and reports those findings to Congress. I understand the Fed acted here because you feel you're facing litigation, but I urge the board to proceed with extreme caution with any type of price control proposals, especially since the first iteration was so clearly harmful. Chairman Powell, knowing of the hardship caused by this policy on low-income consumers, does it give you any pause to continue down this road?
As you know, this rule is out for comment. We extended the comment period to May 12, so we don't have all the comments yet. We'll evaluate them carefully and make an assessment. I mean, the law does assign us a specific job, which is to assess whether an interchange fee received by a large debit issuer for processing a debit card transaction is reasonable and proportional to issuer costs. This is the obligation that Congress has bestowed upon us. Not something we thought we sought, but that's our obligation under the law, and we don't know what else to do than to keep doing it for as long as that's our assignment. That's all we think we're doing, but I think that the concerns that have been raised will be things that we...
Well, hopefully you'll study this and understand that from the previous types of rules along this line, they were very detrimental to a lot of low-income, middle-income folks. As you know, the price reductions that were promised during the Durbin Amendment, for instance, the added profits actually went to the largest retailers rather than go to the consumers, as they were talked about. 98% was one of the studies that showed that the retailers kept all the money instead of lowering prices as they were telling us that were going to happen. So I'm very concerned about that. So what's the legal basis for updating your regulation? You've talked about it a little bit. You believe that there is something in the law that says that you need to be doing this updating all the time, or should you be studying it before you actually propose a rule and make all these things more appropriate?
Well, again, I think our reading of the law is that it's not something you do once and leave it there. It's supposed to be reasonable and proportional to certain identified issuer costs. The implication being there, if those costs change, then this should change. So that's our reading. I think we do a lot of work. We waited a long time to change it. It's been many years since we did change it, but we do quite a bit of work to make this assessment, and we'll review the comments and the data that we get.
One of the things I hope that you consider is the fact that even though it's supposed to be on $10 billion and up, stuff all rolls downhill, and as the last study showed, the smaller banks, the community banks, are also feeling effects of this. So be sure and consider that when you start talking and thinking about this. I appreciate that.
You know, one of the things yesterday I had two different foreign banker CEOs in my office, and one of them brought up the subject to me, which is very concerning with regards to artificial intelligence being able to impact financial institutions in this country and our banking system. And I tell people, I said, you know, think about this for a second. You know, you find some individual who is a well-known individual, perhaps Larry Kudlow, Dave Ramsey, Bloomberg, somebody who has got credibility, and suddenly you see an artificially produced advertisement or Facebook post, and this person says, look here, we've got 100 banks that have got a problem today. Now, that individual didn't do this. It's artificially produced. I've seen a commercial already with individual. You couldn't tell the difference between that individual and the real thing. We have just come through the Silicon Valley situation. And if you have real-time payments, FedNow, where you can instantaneously transfer money, and you have people scared to death by some well-known individual through an artificial intelligence situation, and I can tell you China is watching this.
Jerome Powell, as he testifies before the U.S. House Financial Services Committee in Washington, D.C. Let's listen back.
Do you think there's some issues here we need to be taking a look at?
Yeah, I think we're very focused on AI, many government agencies and law enforcement agencies in particular. It's very challenging. You paint one picture, there are lots of pictures.
Gentleman's time has expired.
It's interesting because the foreign banks actually are watching this. Thank you.
We'll now go to the gentlewoman from Texas, Ms. Garcia, for 5 minutes.
Thank you, Mr. Chairman, and Chairman Powell, thank you for being with us this morning. It's always a delight to have you before us. Chair Powell, the February Congressional Budget Office report estimated that the U.S. economy will grow an estimated $7 trillion over the next decade, thanks to, in large part, to the surge in immigration, creating a larger labor force. Immigration also increases demand for goods and services. I know you mentioned in your report that that the growth sometime during COVID was held down due to some restrictions in COVID and restrictions on immigration. Can you detail how immigrants have been fueling our national growth? And did you consider this report from the CBO in this current report?
So I am very familiar with the CBO report. I've read the demographic projections and I've read the economic projections, so I do understand what they did. And
so you do agree with a $7 trillion growth in the next decade?
I have no judgment on that. I haven't tried to make a parallel assessment, but I'm familiar with the assessment. What they're doing is they're saying more people working, bigger economy, and it makes the economy bigger. It's just arithmetic. If you say that if you add a couple million people to an economy, and a percentage of them will work, then there will be more output, and that's what they're showing. I just want to be very, very clear, though, that we don't make immigration policy. We don't comment on immigration policy indirectly or directly.
No, well, I'm not asking you to do that, but Mr. Chairman, I'm simply asking if you agree that the immigration surge has added to our strong labor force, which is necessary. I think you said that we expect a continued growth at a solid pace. So to be able to continue on a solid pace, then we need that labor force. Wouldn't you agree?
Well, so last year we got a big increase in workers, and it came from two sources. One was participation increased from people who were already here, and in addition, we got a significant increase in immigration, and many of those people take part in the working economy, and so there was a big increase in labor supply. That will have increased output. It will have made more people. It will have all kinds of economic effects. I'm just reporting the facts there.
Right.
I'm not going to say anything is needed for the future or good policy, or indirectly or directly. But I mean, I think it's just reporting the facts to say that immigration and labor force participation both contributed to the very strong economic output growth that we had last year.
Right. Is it possible for the Fed to conduct a formal assessment into the positive impact immigrants have on our economy and report back to Congress?
Not really, no. I think that's a job for the CBO. We don't, that's precisely what the Congressional Budget Office does, not what we do.
All right, but the other question that you've not addressed is, did you consider the CBO's assessment that the growth in the next 10 years would be 7 trillion and about 1 trillion in added revenues. Was that considered in this report? Because that was the February report, and this, I believe, is through February 29th.
So I think that the answer to your question is 10-year growth projections by CBO don't have big implications, don't have any implications really for the current stance of monetary policy. But I will say that the immigration that we saw was a notable factor of the 2023 and 2024 economic outcomes. And of course, we're aware of that, and it plays a role in our thinking about appropriate policy and the path of the economy.
Okay, well, thank you for that. And related to that, I know that the last time that you were here, you and I talked about diversity and diversity and inclusion efforts, both at the Fed, and I applauded you and applauded the president for his appointment of Dr. Adriana Kubler. I expect to visit with her this week. What other strategies and programs are you using in the Fed, not only in here, but in all the branches to ensure that there is diversity and inclusion?
So in terms of intake of people, when we go to hire when the reserve banks go to hire a new president, those processes are very focused on having a diverse applicant pool, and you see the results of that more and more over the years. That happens. We don't have any role in appointments of governors, so that's not our job. The administration does that. In terms of, I'll just say internally, we're very focused on having an open and inclusive place to work. And also in hiring, we work hard to have diverse.
Gentlelady's time has expired. The gentleman from Michigan, Mr. Heising, is now recognized for 5 minutes.
Chairman Powell, good to see you in person. Mr. Chairman, I've got to make a comment here. It's stunning to me that equating an underground economy, which is very different and not a healthy alternative to the regular economy, and basing that on an illegal workforce that's not legally able to work ultimately will fail. That is not a strategy to my colleagues on the other side. So just ask any farmer who's going to then have a regulator come in and fine them for employing people who are not legally allowed to be here in the country. That is one of their greatest fears. So that's just a fallacy of growth within this economy that is not sustainable. Chair Powell, last fall I sent Vice Chairman Barr a letter expressing my concern over the cumulative impact pending rulemakings governing products and services will have on consumers. This morning, there's been a fair amount of time spent on Basel III, but among the agencies, and here I'm including Fed, FDIC, OCC, CFPB, and the number of pending or final rules is frankly just staggering. Regulators last year finalized new rules for the Community Reinvestment Act. The Fed is also looking at Reg II, which in my opinion would unintentionally undermine recent significant progress in bringing low and moderate income consumers into the mainstream banking system. And just yesterday, the CFPB unveiled a rule that would cap late fees for banks. And I just literally walked out of a meeting with my credit unions who are very concerned about those things that may be in their future as well. So I think it's critical that we don't look at any of these rules in a vacuum, and we need to consider their total impact and full scope on that. So I'm going to ask you a question I've asked some of the other regulators. How much do you, as the Fed, and you personally, consult with other agencies on their own rulemaking agenda? Do you coordinate? Do you talk?
I don't lead that area of our business, but I know there's a lot of talking. Coordination, I'm not sure there is coordination.
We're in government. There's always a lot of talking. I'm concerned about the coordinating. All right, well, let me ask you this way. When a rule is finalized under another regulator, are you mandated or have any kind of policy to go back and look at your other pending rules under your purview and see if changes need to be made because of these other agencies' rule makings?
There's no mandate like that. I think where it made sense to do that, though, we would do it.
But you genuinely have some sort of review of that. It's conscious.
I don't think there is a formal review.
Okay.
No.
I've heard repeatedly that elements of Basel III overlap with the Fed's annual stress tests. What are you going to do to address that overlap?
So we're in the middle of just at the beginning, actually, of deciding what to do about Basel III. And part of that may be the interaction with the stress test. So I haven't got anything for you on that today, but that's certainly an issue that presents itself.
We'd like to continue that conversation. I do want to touch on the bank failures of last year very quickly. Do you think that the banks that ultimately needed the government bailout lacked sufficient capital, or was it more of a management problem?
So with Silicon Valley Bank, it wasn't really, could they have used more capital? I mean, they were actually raising capital. It was a capital raise that they announced that triggered the run and everything. So you can argue that it needed more capital, but I wouldn't say that that was the proximate cause, really. It was a funding structure that was all about too much concentration of
well, many of us are, I'm asking the question because many of us are very concerned that those failures are being used as an excuse to raise capital standards across the board. And because the SEC just released its climate disclosure rule this morning, I'm going to touch on the climate related question for you. The FSOC chair has repeatedly stated that climate change is, quote, an existential threat. Presumably a threat that is existential affects banks and financial institutions of all sizes. Why then have FSOC member regulatory agencies, including the Fed, limited their guidance on climate-related risks only to large financial institutions? Why not everybody?
Well, it's a new thing, and we are not.
It's a heck of a new thing. Yes,
we're not climate change policymakers. It's this is something that needs to be handled by elected representatives, and so we're starting this very carefully with large institutions who are already doing it. By the way, the things that we're doing, they're doing this because to remain active internationally, they have to be doing it. So we started with them because they understand it. Imposing it on smaller banks is not something I'm for.
Yeah,
Gentleman's time has expired.
We'll be following up on the Taylor rule. So.
The gentlelady from Michigan is recognized for 5 minutes. Ms. Tlaib.
Thank you so much, Chairman. Thank you, Chair Powell, for being here. Do you agree with the April Federal Reserve report that compensation incentives contributed to Silicon Valley's bank failure?
I'm sorry, did I
So the April Federal Reserve report, it said that compensation incentives contributed to the Silicon Valley Bank's failure. Do you agree with that?
I would say it's at best a tertiary factor, but it probably had something to do with it. For me, not a major.
So that's no?
That's very small.
Okay, so it did. Okay. So do you agree the appropriate rules on incentive compensation could have reduced the likelihood of Silicon Valley's failure? Maybe. If they didn't take all that money.
I really don't think so. I mean,
I don't think all that money.
I don't think it's a first order question for Silicon Valley. A lot went wrong there.
Yeah.
Incentive comp would be.
They actually